China manufacturing PMI, which came in the strongest in 4 months. As we see the economy in China start to be affected by tariffs, of course, but waiting for the big tariffs to kick in. And so interesting to see that that sector has made gains this morning.
This market's all over the place. So this time yesterday, we had, what was it, 500 stocks down? This morning we've got 500 stocks up in the stock 600. So we're kind of swinging from one extreme to the other, trying to get a sense of where we go. And I think this speaks to a market that is really struggling with the tariff narrative.
And energy was the only sector, by the end of yesterday's session, energy was the only sector in positive territory. Today it's one of the worst performers, to your point. So yesterday's sailing high on a 3% gain in oil prices. Today, oil prices look a little flatter, and that sector is one of the laggards.
Absolutely. There's one stock that's catching my eye this morning, and that's Schneider Electric. And this is a stock that's part of your Sensational 6 or Core 6. It is your biggest upside mover when it comes to the stock 600. It's definitely your biggest index contributor for the CAC 30, or excuse me, CAC 40. It comes as HSBC is calling Schneider Electric having a attractive valuation. This is a tech stock that, or a kind of not tech stock, that has traded on tech multiples with this major AI play. It's not one that I would associate necessarily with attractive valuations or attractive multiples, given its rally. And HSBC just upgrading it, saying this is a juicy bid.
It's going to be interesting what happens with the build-out on the AI data center story. They are front and center in that narrative. They provide a lot of the kit that goes into it, not in the chip story, but in the how do you actually get the electricity into the data center story. And I think that's been one of the key kind of narratives around it. It is up quite strongly today. But you look at the news overnight in terms of the CHIPS Act. You look at what is happening in terms of what Howard Lutnick's trying to do in terms of the volatility around that story as well. Is that going to throw further sand into the gears of that story and how it develops in the United States? Just more uncertainty. So it's interesting that Schneider goes higher on this upgrade this morning.
Absolutely. You just mentioned ASML also higher by 0.8%, but in line with the broader rally that we are seeing across the board. Let's see a little bit more analysis here. Salman Ahmed, Global Head of Macro and Strategic Asset Allocation over at Fidelity, joins us around the table. All right, so the markets are happy, at least on the surface. It feels like it, at least today. Yeah, today. We'll see how long that lasts. Maybe a couple of minutes or counting. How do you think about where the defensive trade in this market is?
So I think taking a step back, I think the shock is an economic policy uncertainty shock, not a liquidity shock as yet. So I think I'm not surprised that the market is swinging around because, we have been used to a lot of liquidity shocks in the past where, markets take stress and it's very quick and sharp. This is more about, where is the economy going to end up in 6 months or 12 months' time. So in that, with that context, our defensive exposures are focused on, firstly, thinking about, will this bond and equity correlation story stay, which is like bonds have been doing still quite well versus equities when they come under pressure. A, will that stay if inflation becomes stickier? And then B, what is the role of, for example, precious and gold, for example, downside protection through options, and then defensive stocks in this environment which are away from tariffs and risk around that. I think that's where our focus is. And then diversification is your friend here. So last 2 years, it has been, diversification had a negative risk premium, but it is now coming back that diversification actually in portfolios can be quite useful attribute to have, and I think that stays in place for the next several months.
Well, Guy likes to point out that if you diversify, you lose money, or you have at least.
You have, right? Yeah. That was the story of the last few years.
Yeah.
As we're hearing, that's changed. Like gold and things like that, other assets like that are definitely changing that.
How much of that, to Guy's point around gold or around this kind of inverse correlation that you point out around the bond market, has more to do about the yields that the equity market is delivering? How are you thinking about that?
So I think equity markets, obviously, we had concentration risks, as I think Guy pointed out, building up over the last 2 years. That theme is also quite powerful. I haven't spoken to anybody in our client base who likes MEC 7 right now. And market goes up, market goes down. There is this structural, I think, cautiousness appearing around MEC 7. I think that's as important theme as the tariffs themselves. And to your point on income, I think we are now seeing the return of fixed income becoming a return generator rather than a diversifier. We have lived through an era where, real returns from fixed income were negative. Now, potentially we are entering an era where, you can get actually returns from fixed income, but at the cost of very low diversification vis-a-vis equities. And then to your point on equity itself, the biggest winners over the last few years were not paying a lot of dividends. So that also is changing and shifting. So a lot of seismic shifts underneath the surface as well.
We just don't know at this point what is going to happen next. And the tail risks are absolutely enormous. Diversified portfolios may protect me a little bit from that. But if you think about kind of diversification within equities, people have moved out of the United States into Europe. Is that going to be a trade that sustains? We've got tariffs coming towards Europe now. Is that enough to undermine the fiscal impulse that we're seeing out of Germany? How much certainty do you have around what you see in European equities at the moment?
Very important question, Guy, in that sense that, firstly, let's start with who is buying Europe firstly. I think that's important. Firstly, Europeans are buying Europe. We have not seen US buying of Euro happen yet, right? So a lot of flow has been Europeans, investors who have been underweighting Europe because of various reasons over the last few years, maximum sucking
they're taking money out of the States and putting money, they're putting their money back.
Exactly, and they are now bringing it back. Just to give you a sense of the numbers, UK exposure to US securities as a percentage of GDP is more than 100% now. 125% for Switzerland. And these numbers used to be 30% 15 years ago. So a lot of capital went to the US. And I think that's domestic capital coming back. But US capital so far has not entered Europe. So that's important in terms of the next leg of demand. If there is a structural shift in the Europe's outlook beds in. And to your second question on fiscal policy response in Germany versus the impact of tariffs, if we get 10% tariffs on Europe, then the fiscal response can cover that. Anything above that, we are in a cyclical...
Okay, so what do you think the number's going to be then? What are you modelling?
So we are basically modelling a scenario whereby, we overshoot around 20-25%, but that is not a steady state. It's used as a negotiation tactic. And then we start to get a steady state.
But the initial reaction, therefore, if it's north of 10%, will be for very negative equities to sell off.
Because it's a recessionary risk and the timing mismatch.
Okay.
Yeah, Salman, I ask you the same question as I asked our guest in the last hour, because I think going into tomorrow and Thursday, this is interesting. Do you have a sense of what is priced? I mean, you were just talking there about what could be high numbers, I suppose, and that would be kind of risk off.
Yeah.
But even if we get numbers that are a lot lower than that, could we still see a risk-off reaction? Because I'm quite taken by the fact that when we got the news on autos, for example, we knew that was coming, really, but yet we still saw selling.
Yes. No, definitely. And I think that's where immediate reaction can be dependent on the news flow which hits the day. And it's also not just the number. It's about, are we going to get exemptions? You can throw in a big number and say, by the way, everybody is exempted from these big numbers. So it also depends on, I think, the news flow around that and context of that. But I think it's becoming a bit more clearer that tariffs are A, here to stay. B, there's a lot of uncertainty which is being picked up by business surveys, not the markets, but business surveys. We speak to our corporates, and our analysts speak to corporates, for example, in the chemical sector. No, everybody is frozen. It's complete paralysis when it comes to any kind of capex decision, and I think that will take time to build through. So I will discount the immediate reactions of the market here.
Okay, so some industries in paralysis, not investing. Some consumers, no doubt, caught in amongst all of this news flow and feeling that same kind of paralysis. So if that's where risk sentiment is broadly for the US economy, what recession risk are we looking at?
So early February, we have been pumping up our recession probabilities. Now we are basically in the camp that either this year we get a stagflationary type of a situation in the US whereby inflation goes back to around 4% in the event that tariffs are implemented rather than being discussed and threatened. And then, or a clear-cut recession whereby you basically get a contraction in GDP. I think those are the two scenarios we are fighting with from a up to 6-month, 9-month horizon. We do not see how reflation takes hold, even though there is potentially deregulation and tax cuts in the pipeline. But that will be a 26 story, given the sequencing and timing we are seeing at the moment.
Okay. Interesting question on Stock 600 versus the equal weight. We'll come back to that another time on the IB from a viewer. Simon, nice to see you. Thank you very much indeed. Simon Ahmed, Global Head of Macro and Strategic Asset Allocation, joining us from Fidelity. We've been talking about Schneider this morning. Let's take a quick look at how it is trading. In fact, we'll take a look at the whole Core 6, as you can see, which is positive, very positive this morning. It's interesting, actually, there's not that much divergence across in terms of the numbers, other than in the pharma sector, where you are seeing quite a decent pickup this morning. Novo has been battered of late, though. Take a look at the one-year chart of Novo Nordisk. It made some rather bleak reading from the highs that we saw to where we are now. Let's check in on some other stocks and talk about what is happening here. Joe Easton has the details.
So lots going on in the pharma space today, guy. Quite a lot of movement in this sector. A few stocks to bring you. Gubra, this one is an obesity stock over in Denmark, kind of a smaller competitor to Novo, and also Lilly in the US, reporting some strong results from their latest obesity trial. Then we've got Astra with the strong cholesterol drug news that we reported earlier. That one gaining around 2%, pretty decent in terms of the points move for that one. And Bavarian Nordic as well, with news of the approval of their Mpox and smallpox vaccine in the US by the FDA as well. So all of those getting a bit of a boost and providing some positivity on the pharma sector today. Then in terms of Travis Perkins, not much positivity on that one. We're down 11% now. Analysts saying that earnings estimates may have to come down by 25%, and really surprised by the magnitude of the downgrades and the downbeat commentary from Travis Perkins, the UK construction supplier to both wholesale and also retail as well. Really hit hard for TPK this morning. Then a decent one to the upside in the UK is Greencore. You might remember this one as the company that recently bid for Bakkavor in the UK. That's a Tesco supplier, maker of the ready meals. This one reporting a strong trading update today. Really good numbers in terms of their quarterly results as well for Greencore. So a bit of positivity on that sector. And then over in the ratings, you guys have been discussing Schneider Electric. That one was ticking higher in Paris, and one of the biggest points contributors to the CAC index this morning. This is all about the valuation. We have seen a 13% drop in Schneider Electric shares already this year before today, and HSBC saying that the valuation is now more reasonable because of that, so therefore they become buyers, and that one is getting a decent lift this morning. And finally, the worst performer on the Stock 600 before Travis Perkins opens, this was Genmab, downgraded at Bernstein because they're about to lose exclusivity on one of their key cancer drugs called Darzalex. Now, this is about to create a patent cliff, according to analysts at Bernstein. So they're downgrading Genmab today, one of the biggest biotech stocks in Europe, and that one is falling 4.4%. So ending on some pharma negativity, following the pharma stocks that were rising earlier. Genmab falling in Copenhagen this morning.
Joe, thank you. Joe Easton from our equities team with a rundown of those stocks on the move. He was talking about the pharma sector, and we'll return to that sector because we've had plenty of news flow there. Coming up, we'll take a closer look at the pharma space. Following the news of AstraZeneca's potential game-changing cholesterol drug, the stock is up by just shy of 2%. There's a link here with obesity because you can issue these in combination. We'll get the details next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Let's talk about the session that we are seeing in front of us. At the moment, fairly positive. We knew this was going to be the case because what we saw yesterday in the United States was a late bounce, and that is certainly delivering a nice bounce first thing this morning for European equities. But the week is still young. It is the 1st of April. We are waiting for the 2nd of April. We are waiting for 3 p.m. in the Rose Garden tomorrow. That will determine, I suspect, what the rest of the week might look like, Chrissy.
Absolutely. Let's go into one of the major stock movers we are keeping an eye on this morning. An experimental drug by AstraZeneca has been found to have a form of cholesterol linked to heart disease in a mid-stage trial. Now, the findings could open the door to powerful drug combinations. Bloomberg Health reporter Ashley Furlong has reported on the story, and she joins us now. Walk us through what we've learned from the studies.
So we've seen about a 50% reduction in levels of bad high cholesterol, and that's on top of statins. So that's the existing standard of care that millions of people around the world are on to control their high cholesterol. And this is a daily pill, can be taken any time in the day, really. And we've seen that as the results we see are pretty significant, and they meet what AstraZeneca was hoping for.
Yeah, you mentioned actually statins, which is what lots of people with high cholesterol will be familiar with. So how does this drug sort of rub up against that and other existing medications?
So it would be taken in combination potentially with statins, and there's already similar drugs that target the same protein that are available on the market, but they're injectables, so not as convenient as a daily pill and actually more expensive. So AstraZeneca is hoping to sort of tap into this market with a highly effective once-a-day pill that could potentially also be combined with a GLP-1 one day, and that's obviously what's getting people very excited.
How excited? How much could this be worth?
Well, it's hard to know. You know, this is still phase 2, so mid-stage trial. AstraZeneca saying over $5 billion. We've seen some analysts say $8.5 billion. That's obviously just the single pill, not potentially the possibility of a GLP-1 combination with this, with the statin, all in one little miracle pill you take once a day.
So how much is this miracle pill going to be making?
That's hard to know what that total pill will make in the end. And also, we haven't seen any of that data. So that's many, many years away, that combination pill. But as we've seen, you know, the excitement around very early phase data on any obesity asset, you know, really gets investors excited. So, you know, even the talk of potential combinations.
Was it Roche that had the phase 1 data that got everybody super excited?
And today we've seen data from Gruber, you know, also phase 1 on obesity assets. So, you know, everyone gets excited by, you know, data we'd never imagined.
Before tariffs and AI, there were obesity drugs.
Well, you've seen Nova's share price. Utterly amazing in terms of the sell-off that we've seen there. That story has lost some weight.
So that's interesting because that's obviously based on, we're seeing prescription data from the US that's not meeting investors' expectations.
Yeah.
But there's also disappointment around the data that we've seen on the next generation obesity drugs.
Yeah.
And that just shows, how much investors are really, pinning their hopes on what's coming next after GLP-1s.
I'm disappointed in Guy's puns.
I know.
Don't think it went unnoticed.
It was all right. Ashley, thank you very much indeed. I'll work on that. Ashley Fuller, thank you very much indeed. I now will spend the rest of the show thinking about better puns. I can't think about them right now. European equities have, of course, ended what has been a fairly solid, some would call it a bumper first quarter. Certainly, European equities have outpaced the United States equity story by some considerable distance, nearly 17%. Defence stocks have been some of the main standouts in this story. Let's take a little review, and then we'll think about what comes next. Michael Basika joins us now around the table. Europe outperforming the United States. Now, sometimes this happens at the beginning of the year, but it never lasts long. It usually fizzles out fairly quickly. This time it did. Why have we had staying power? And is it all basically about this German fiscal push and what is happening with the defence narrative?
Well, Guy, this is kind of an exceptional outperformance that we had. So the thing is, there's a lot of things going on for Europe. We had like a massive valuation gap against the US as we came into the year. We had a fiscal policy that was likely to be better, even though we didn't know exactly what was the extent of the German fiscal package, but now we do. And we had a monetary policy which was much more accommodative in Europe versus the US. So all in all, and the last one, of course, positioning. You had like, everyone was maxed out US stocks and everyone was short European stocks, or like barely exposed. So we had a switch, and that switch clearly explains the outperformance that we've seen over this past quarter. Now, having said that, the past month, if you look at both benchmarks, the S&P 500 and the Stock 600, they're both down 5%. So the gap, the performance gap is still there. It's the same one, but now those benchmarks are moving in concert.
And is that because of the tariff threat?
Exactly. So that's a tariff threat, and that's the global growth kind of pessimism that is building up right now. So the impact of tariff will definitely hit US, will definitely hit Europe, and now investors are getting more cautious.
So, Michael, we've been talking a lot about, and you kind of mentioned their positioning as well. One of the conversations we had yesterday was that people are not positioning for the long dollar the way they did in the first iteration of Donald Trump in the White House. What are they positioning for? What assets are seeing the most love and the least love?
So it's a strange one as well. There's definitely still a lot of love for Europe. Asset managers are really highly positioned on European stocks, on European assets. We've seen the dollar getting hit lately. So this US exceptionalism has kind of peaked right now. And now it's a bit more balanced. But you still have like a big valuation gap. It's not closed yet. There's still a lot going on in Europe. So we have like a more balanced kind of risk where you have a lot of exposure to Europe that is vulnerable to the growth scare, and at the same time, a lot of the positive that keep investors, invested in Europe.
How vulnerable is this, though? The tariff story is enormous, and we just don't know what the GDP hit ultimately could be here. If US stocks continue to drop as well, what does the beta look like? What does the kind of the relative story to the United States look like into the second quarter? Because it's been a really positive picture first quarter, all of the things you talked about, but they're in the price now. So second quarter, it feels like the negative news has the potential to be priced in as well. How significant? What are you hearing in terms of the potential for the underperformance or overperformance? Because this is the bit that I can't get my head around at the moment.
So if you look at, for example, earning expectations, they're starting to roll over. I mean, in the US they have. In Europe, they are starting to now. Goldman Sachs cut their targets today. So EPS growth for this year is 2%. Next year, 4%, 5% in Europe. So that tells you that how much people are getting cautious. If you look at the performance of European stocks over the past quarter, 100% of it is valuation expansion. It has nothing to do with earnings. So again, that tells you that the optimism had built in, and now that optimism can fade as well. Okay. And so the risk is that if we start to see growth rolling over and earnings starting to be downgraded, then you'll see more downside in Europe.
Bloomberg's Michael Masico walking us through maybe what we're seeing in the markets ahead of tomorrow's Liberation Day announcement. As he said, a lot of this may depend on maybe what kind of retaliation we get from the European Union. We might have a little bit of insight here. We're getting comments, or did get comments, I should say, from Ursula von der Leyen. She is speaking, or had just spoken, over at Strasbourg at the European Parliament debate, saying that they are keeping their options open when it comes to retaliation, but have a strong plan to do so if necessary. They're also diversifying their trade with new partners and are looking at a need to remove the EU internal market barriers, tasking Stéphane Séjourné to find a proposal for that EU market story. So we're likely going to see a very quick reaction, a very swift reaction from the EU when we do get some insight from the White House, perhaps, of what the tariff picture does actually look like. Lots going on in the next 24, 48 hours. We're going to have you covered right here at Bloomberg. Stick with us. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
This is the opening trade. We're 30 minutes into today's session, seeing a complete rebound when it comes to European equities, perhaps catching up to the market message we got in yesterday's session over in the United States. But again, really paring back some of the losses we saw in the European session. Take a look at the outperformer this morning. It is the DAX, higher by about 0.9%. The underperformer, although still higher by about 0.5%, is the French index. This is, guys, very surprising to me because some of this kind of feels like a very knee-jerk reaction. It's buying, to some extent, the dip that was yesterday. Very broad losses yesterday, so a broad rebound today. Does that stick into the rest of the week? Do we see a little bit more nuance when it comes to which maybe countries outperform rather than which sectors outperform.
Yeah, we feel a little headless on the tariff story, don't we? And there's just so many questions. You know, what the news tomorrow night looks like, 9 European time. Of course, that's not where it ends. We were just talking in the break with Michael Masika about the fact that as soon as you get the news, you brace for more news on the on Trump tariffs, because that's where we've been. And also, where in these supply chains do these tariffs fall? We've spoken to lots of people who supply the car sector, for example, and they've all been really confident about how they're just going to pass this all on to their customers. But, you know, this has to be paid for somewhere along that supply chain. And in every industry, we're going to spend a long time trying to work out where it falls.
Yeah, and you see the ripple effect coming off into the used car market, into the insurance market. There are secondary, tertiary effects that come through from this, which are really quite significant. And then it's the Fed, then it's the central banks that start being concerned about this as well. So the effects of this, I think, it's so hard to model. And as we were just discussing, the ambiguity around this story over the next few months and weeks are incredible.
Well, that's the key point, right? Do the numbers even matter? Which I know is a controversial thing to say, because what if the clarity is what matters, where the reaction function is as much more, to your point, easily modeled out. Then you know that if these are the numbers from the tariffs, then this is going to be the reaction function from Jay Powell. That is way easier to navigate than the push and pull.
And it's that sense that you never get to the numbers, because there's always another number, isn't there?
Yeah.
You know, as we saw recently with some threats to put even bigger tariffs on Canada and the Europeans if they collaborate and coordinate. Right, let's try and get some perspective on this story. President Trump is set to unveil his so-called reciprocal tariffs at an event at the White House Rose Garden. That comes tomorrow, late European time. The announcement is expected to feature so-called country-based tariffs with, we're told, no exemptions. Speaking to reporters, Trump dismissed concerns that the levies could impact relations with Washington's allies.
Are you concerned that this move, the tariffs this week, could push some of the United States' closest allies to work with China?
No, I'm not worried about it. I'm not worried about it. Yeah.
Mr. President, can I ask you
I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs because, you know, they've been unfairly tariffing the United States for years.
Let's bring in Bloomberg's Oliver Crook, who's, of course, tracking this story as we build to those announcements tomorrow night then, Ollie. I'm going to ask you that impossible question. What exactly are we expecting to be announced in the Rose Garden tomorrow?
I think I'll respond to that with another set of questions, because I think that sort of what we're trying to find out from the Trump administration, again, we were trying to, you know, there's what we know, 25% auto tariffs, there's this question of reciprocity on the tariffs, there's all these sort of questions that we need to basically clarify. But I think what will be very interesting to get from Donald Trump and get to the from the White House is this question of methodology, this question of calculation. How are they thinking about these tariffs? Is this going to be just that a question of simple reciprocity where you say, hey, listen, our trading partner has this rate, we're going to take the average across all of the goods, and then we're going to put up this rate? Or are they going to try to write other economic gripes that they have with different nations? And I think that that is at the center of the real concern for some of these European policymakers here, where they're talking about not just the tariffs, but maybe they also want to address the issues that they have with value-added tax. Maybe they also want to address issues they have with digital taxation, maybe with some issues of regulation. And if that is the case, and if you do get these tariffs that are calculated in some way off of some of those other concerns, the question is, even if you do get to an agreement, what will prevent the Trump administration from, you know, coming back a month, 2 months from saying, actually, you know what, we also think this is unfair, and we're going to take this into account into our calculations. So again, I think this is all sort of to play for here for these European policymakers who tried to get some negotiations going last week in D.C. The Trump administration apparently had basically no interest in any of those discussions going into this. And when we look at sort of what is at stake over the next couple of days, though we don't know what the sort of reciprocal figure is for the EU, we expect it to be somewhere in the double digits, between 10 and 25%, but we really don't know. These sort of industries that are most at risk for the Europeans is the pharmaceutical sector. That's about 23% of exports to the U.S., and the car industry, 10%. And we know that both of those industries are going to get hit very hard tomorrow.
The comments from von der Leyen this morning, she's speaking in Strasbourg, Critty was bringing us the comments a little bit earlier on, EU to keep diversifying its trade with new partners. What does that look like? Is that the longer-term plan, basically to pivot away from the United States? And we have a strong plan to retaliate if necessary. That's the short-term plan for the United States. How well thought out are both of these two objectives, do you think, Ollie? The short-term plan, maybe there's more effort and thought gone into that. But the longer-term plan to diversify away from the United States, is that something that can really be done?
I think that really it's a very, very long-term project. I mean, you talk to a number of policymakers and leaders, and you ask them about one of the kind of central questions, I think, in terms of the goods that they get from the United States, and that is in the defense sector. And the number of people that I've spoken to, what most of them say is basically there is no alternative. You basically just need to stick with the U.S. for those sorts of things. But at the same time, you start to hear from some of the more forthcoming policymakers and those who are speaking a little less guarded that basically if the United States is willing to exert points of leverage, basically in anything, including the sort of defense industry, you know, what about withholding orders? What about basically all of this military kit that needs to be software updates and maybe needs to be operated in part by members of the United States? If those things are at risk, if those things are on the table in terms of negotiations, then European policymakers need to think very seriously about sort of what place that occupies in their defense architecture and indeed in their sort of system going forward. And then you also hear from the Trump administration, I thought this was very telling last week, where he said basically if Canada and the Europeans begin to sort of get together and try to circumvent U.S. tariffs, that they're going to pay an even higher price. That means that the Trump administration is seriously considering that that is going to be one of their approaches. So I think that for the longer term, that is certainly going to be the playbook, though, again, it's going to be a question about how long it will take to actually effect that. In terms of the shorter term, Guy, I will say I think they're taking a much more cautious approach than they did originally with Trump. You see that they don't retaliate immediately with everything. They really want to get the thinking out, and they want to be sort of taking a measured approach. But again, at the end of the day, the Europeans do have a very large market, despite the fact that they run a large trade surplus, and they're going to intend to use it in any negotiation with Donald Trump.
Ollie Crook in Berlin, thank you very much indeed. Let's look at this from a UK perspective. Britain has been, of course, engaged in intensive negotiations to secure an exemption for UK goods from US tariffs. The Prime Minister, Keir Starmer, held, quote, a productive discussion with President Trump. That took place Sunday. Nevertheless, his government is bracing for some impact from what we are about to learn at 3 p.m. in the Rose Garden on Wednesday. Joining us now to discuss all of this is Crawford Falconer, the UK's Chief Trade Negotiation Advisor from 2017 to 2024. Good morning.
Morning.
Nice to see you. What should the UK be expecting, do you think?
Well, nobody ever seems to be able to be sure about what they're expecting, but it sounds like there's going to be an application of tariffs to the UK. Quite how they're going to apply is anybody's guess, but there'll be something, it sounds like, that's going to be applied forthwith.
What you've just said, the huge amount of uncertainty. You are a guy that knows how this process works, and you're sort of shrugging your shoulders, which I find quite astounding.
Well, yeah, that's because the process doesn't work the way it's worked for 25 years, and that's the whole point. But, you know, from what you read from the media, even as of this morning, the rumours about how it was going to apply are flying around, but it looks like there will be at least a fixed tariff that will apply. But whether it's differentiated by countries, nobody's really sure. The guesswork is that whatever the Trump administration considers to be the worst offenders will get higher tariffs, and the UK, in that case, would probably be down the order a bit. But as I say, it's anybody's guess. Nothing's been signalled very clearly. I mean, it might have been signalled to the PM in his call, but obviously if it was, nobody's going to let on. And frankly, the way things work in Washington these days, whoever might have said it to him, if it was the president, might change his mind. So, there it goes. Sorry, I'd love to be able to give you certainty. And if I had that certainty, I wouldn't be telling you anyway. I'd be profiting from it myself. But no, I don't think so.
Well, uncertainty out of D.C., but what about the response from London? There's a big question here about what levers can be pulled from the UK, from the European Union, from other trade partners as well. What does the UK have to offer should it come down to it?
Well, it can... Look, it's got lots of options, but, you can retaliate. Of course you can retaliate. I don't think at the macro level there's leverage for the UK to achieve some outcome from that right now, but you might want to do it just to prove that you can do it. You can also do it surgically, which affects certain parts of trade. But, of course, it imposes a cost on you. So I think you do that if you believe that you're not going to get anywhere fast with the administration. That would be my judgment. And at the moment, all the mood music is that, okay, he's going to apply these tariffs, but there's going to be a genuine negotiation. If that's true, and the government believes that that's true, then, you might well hold off any prospect of retaliation until you test that more seriously. Leverage-wise, there's a certain commercial importance to the United Kingdom. We're still a G7 economy, and there are economic interests in having a degree of stability with us in our trade, and US business will want that as well. He's not completely closed to that. Plus, you could do a reasonably good deal with the United Kingdom that would be a model for others. And I think we're more disposed to doing that than some other countries. So if he wants to leverage other larger economies, he might well be able to say, look, and the Brits are doing this, and therefore this is the kind of model we want to follow. So you have those kinds of advantages, and the relationship with the US, beyond the trade and economic side of things, is rather unique. I mean, you don't want to over-exaggerate how unique that is, but there seems to be, defense and strategic considerations that would be positive. You don't kind of commercialize them in a kind of dollarization way, but I mean, it certainly affects the readiness to deal with us.
You talk about the fact that a roadmap of 20, or the experience of the last 25 years is not necessarily a roadmap of what to come. But historically, we have seen the UK get certain carve-outs when it comes to defense and other kind of realms. Is there a possibility of carve-outs, do you think, from this administration?
Well, I mean, it sounds like there's not going to be a carve-out from day one. I mean, they're going to apply something from day one, and the rumour seems to be they're going to apply something to everybody, whatever it is, anybody's guess exactly. So the question is, you'll have to negotiate your way out of it subsequently. Now, I wouldn't call something you negotiate thereafter as a carve-out. I think it would basically be a deal which means that those tariffs, or the bulk of them, are removed. From the sounds of it, and you have no way of really being sure, from the sounds of it, whatever that negotiation is will not be an old-fashioned goods trade negotiation, nor will it even be a reasonably up-to-date goods and services negotiation. It sounds like the Trump administration, leaving aside what the UK government might want, wants something that's more broad-ranging than that, and you've seen it in the media, so it's probably true. And they talk about value-added taxes, they talk about digital services taxes. Goodness knows, by the time we finish, the kitchen sink will probably be in there as well. But I think it will be a broader negotiation. And from the UK side, it would seem to me that there are a lot of interests the UK has that the United States might be uncomfortable with, and the US should have its own interest in that. So that will probably take a bit more time. I mean, I don't think you're going to do that on a wet Sunday afternoon somewhere on the outskirts of London.
Can I ask about the VAT? President Trump clearly doesn't like VAT in Europe, in the UK, and the rest of the 80% of the world where it applies. So what should the stance be there? It seems unlikely, does it, that any jurisdiction is going to rewrite its VAT rules based on US objections? So what's the stance?
Well, I find it hard to believe, but then again, I find lots of things that are happening at the moment rather hard to believe. But I don't think so. I don't think you can really completely restructure your tax system, and you're certainly not going to get rid of VAT overnight. I mean, there is a question which I think you can talk about, and it may even lead to some margin of negotiation. I mean, it is true that a value-added tax or a sales tax or consumption tax of some kind, of course, has some economic interests, has some economic effect, and it will have an economic effect on players that export to your market. It should have an equivalent effect, so it's not giving a domestic advantage to your firms. But it is true, the whole point of a consumption tax of some shape or form is to suppress consumption. So, I mean, economically, if you're exporting and the US is exporting, you would say, well, okay, that tax kind of diminishes to some extent, demand for my products. But it does for the domestic country as well, so what's your problem? But there's no denying that there is some kind of economic effect. So the question is, are the compliance costs particularly high? Is the way in which it's being implemented problematic? The answer to all of those questions may be no, in which case you wouldn't do anything. If there's something there that's a bit legitimate, okay, you talk about it.
So maybe there's room to offer something. And is there room to what extent are services going to be part of this, do you think, then, in terms of the opening salvo from the Trump administration on this? Are services going to be part of that?
I don't know. I have no idea. But certainly, because again, I'm not inside, and I have no idea what they've been discussing. Two things about it. I mean, one, it's interesting, there's not much noise about services from the Trump administration at all. I mean, they are kind of old-fashioned goods obsessed, it would appear, on their agenda from the outside. From the UK's point of view, if you were going to deal with the United States bilaterally on trade, then of course services will be a huge part of what you would be interested in. I find it extraordinary that the US would not be if that was the case. And I would have thought that there'd be a whole list of things that you would want to ask of the US on the services side. For instance, you might want to have, fly-in, fly-out visas for business people to visit the US. The Australians got that in the trade agreement they did with the United States when things were a little more stable a couple of decades ago. So there are things like that you would ask for. But I have no idea as to what the agenda would be, let alone what the disposition would be. But it's pretty extraordinary that that's where the real economy is, and it just hardly ever figures in these discussions. When it comes to sales tax, for instance, and there's an interesting angle to all of that, and certainly in financial services, they're pretty loosely applied, at least as far as the UK. There's not a lot of value-added tax that's applied to services transactions on the financial side. So, there's the bizarre thing. You're worrying about seemingly worried about it when it comes to goods, but on services, which are economically the most significant, it tends not to be applied anyway. I mean, there are some exceptions. There are areas where it does apply, but it's not generally the case.
How does the UK sit between the United States and Europe? It wants to probably negotiate some kind of a deal with Europe going forward. We're about to see a big meeting about what that could look like. But the Europeans seem to be very much on the naughty step when it comes to the Trump administration. And then you've got the kind of story with the United States. Is there a danger of the UK getting too close to the EU at this point in time from a US perspective?
Look, I mean, there's a balancing act, and that balancing act is undoubtedly, or could undoubtedly be tricky at certain circumstances. I mean, remember that the government has made it clear that it has no intention of joining the single market, let alone the customs union. So therefore, it's not going to bind itself in contractually, it would appear, with the EU. So on that assumption, there is no reason to believe that its hands are going to be tied so that it is in lockstep with the EU. Now, that doesn't mean to say that there would not be things that it would be interested in doing with the European Union outside of those two conditions that would bring it a bit closer to the EU. And I think the question for a negotiator would always be, but whether the negotiators succeed in doing this is, well, I'd like to keep my options open in this as long as possible. So I don't want to foreclose a deal with whatever it may be with Europe before I've sort of seen the colour of the US money, and I don't want to close a deal with the US until I've seen what the Europeans are really offering me. Now, ironically, in most occasions where bureaucrats are doing most of the work, there's very little risk of anything happening quickly, so that kind of strategy works quite well. Now, it's going to be very interesting because we're going to actually be in a situation now where the irresistible force of Trump time is going to meet the immovable object of Whitehall time. And it'll be very interesting to see what happens on that. But my view is that there are some things, particularly in agriculture, where we want to have a slightly more smooth arrangement with Europe than we've had in the past. You'll have to be very careful to know whether what the EU would consider to be necessary for that kind of deal would really preclude what you might end up having to do with the US. I don't think it's impossible to manage it. It could be a bit tricky over a couple of areas, but I don't think it's necessarily. To me, I don't see a fundamental choice there. As long as the government's position remains what it is, there's just a bit of very tricky negotiation that would have to be done on a few products. Is basically it. I think the real question is: is there going to be such a significant prospect of a deal with the United States that would make a difference? And that, I think, is the challenge. I mean, the UK needs growth. It can do some marginal things with Europe that will improve things at the margins. Is Trump, as he says he is, ready to do transformational trade deals as long as he gets his interests taken care of? Because if he is, that gives a huge opportunity for the UK to really move the dial on its growth with the US. So I can't imagine that you would shy away from that prospect if it's genuine. What remains to be seen, is it genuine on the part of the US? And we have to test that.
I've learnt a lot. Thank you very much indeed for stopping by to inform us. With an occasional shrug of the shoulder. Crawford Falconer, former UK Chief Trade Negotiation Advisor. Thank you very much indeed. We're going to carry on with the conversation around tariff risk and inflation and what that's likely to do to the ECB's thinking. We're going to look ahead to Euro area CPI data. It's due later. This is Bloomberg.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. Bloomberg has learned that several European central bank officials are set to be wavering on whether to cut interest rates next month. They will be closely watching the euro area inflation figures due at about 10 a.m. UK time. Bloomberg's euro area economy reporter Alex Weber is all over, and he joins us now. Alex, walk us through what we are due to expect from the inflation figures in just over an hour's time.
Yeah, so we should expect another slight slowdown in the headline figure to 2.2%, so still slightly above the ECB's goal. We've already had reports from all of the biggest euro area economies, and they confirm that expectations. The data were a bit mixed, but on balance, they point to another slowdown. That's partly because of lower energy costs, but we're also paying particular attention to the services inflation number. That has been stuck much closer to 4% for a very long time, and that's really worried the ECB. Now we should expect a more significant slowdown to somewhere around 3.5% maybe. That should give the ECB some confidence that they are on the right track. As regards to the next interest rate decisions, of course, there are a lot of other uncertainties, but when it comes to inflations, that should be some good news for the ECB this morning.
Okay, we will see if that's exactly what they get then. Alex, thank you very much for that. Alex Weber with the latest on inflation expectations. That data then hits in around, as Kriti was saying, in around an hour's time. That's euro area inflation. We'll also get US ISM manufacturing. We'll get US JOLTS numbers as well. And of course, anything to do with the labour market could be really interesting, given that we're working our way towards jobs numbers at the end of this week. And from what a lot of the people have been talking about this morning and recent conversations, it seems that markets are more concerned in the moment about the growth slowdown rather than anything inflationary. So looking for any clues on either of those fronts in any of the labour data.
But shouldn't you? The manufacturing data is therefore going to be quite interesting, and it's going to be fascinating to see within that data whether or not there's been front running of tariffs and what that will tell us about what happens next. The ISM data has picked up slow, sort of gently at the beginning of 25. It's starting to turn over a little bit.
Yeah.
Kind of how quickly, and does that number continue to accelerate, particularly once the tariff story becomes a little bit more clear?
Well, that's something we've seen in the PPI numbers as well in terms of that front loading. We've also seen it in the Chinese data, for example, in the shipping numbers in terms of Shanghai and LA when you look at those volumes. So you are starting to see pieces of it, but it is very similar to the conversation we have in the bond market, which is this could be significant. We don't know if we're there yet.
Yeah, absolutely. And we do already have an increased set of tariffs, don't we? I think 6.6% is the average US tariff now, according to Bloomberg Economics. That's up from below 5 for the last 50 years. So we're starting to see that, but we certainly brace for further impact, further tariffs coming in the next 24 hours or so, certainly late Wednesday. That is it for the opening trade. The Pulse is coming up next. They'll continue to bring you the latest moves on these markets. European equity markets making gains this morning. US futures point a little lower. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Traders
Traders brace for more volatility on the eve of Donald Trump's Liberation Day, when the U.S. president is set to unveil his so-called reciprocal tariffs in the White House Rose Garden. France's Marine Le Pen says the rule of law has been violated after she was banned from running for office following her conviction for embezzlement. Plus, funding from the U.S. CHIPS Act is in limbo as Commerce Secretary Howard Lutnick seeks to renegotiate the terms. Now, later in the program, we'll also be joined by the Travelex founder, Lloyd Dorfman, to discuss the challenges of doing business with all of the uncertainty around U.S. tariffs. But first thing is first, let's look at the European markets map. Again, we've seen quite a lot of movement when it comes to some of these markets. Stocks seem to be bouncing around in the countdown to U.S. tariffs. Look, we know that Trump is set to announce these reciprocal tariffs on Wednesday. To the extent of his levies remains unclear, and so there's a lot of investor uncertainty out there, leading Wall Street strategists to lower some of their estimates. Yesterday, we had a down day. Today, you can see European stocks a little bit up. Now, we always look at gold. Certainly, we do since the reciprocal tariffs were put in place, or at least they've been announced. And you can see gold, S&P futures actually down 0.3%, and gold 3,126. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump is set to unveil his reciprocal tariff push during an event at the White House Rose Garden tomorrow on what he's called Liberation Day. Now, the announcement is expected to feature so-called country-based tariffs with, we're told, no exemptions. But he's promised to be kind.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
Now we're joined by Hugh Gimber, global market strategist at JP Morgan Asset Management. Also with us, Rosalind Matheson, Bloomberg's EMEA News Director, and Brendan Murray, who leads our global trade coverage, to figure out exactly what we'll be faced with tomorrow. So, Brendan, I mean, look, we know that Donald Trump is announcing these reciprocal tariffs, but actually the extent of his levies remains unclear.
Yeah, exactly. So it sounds very generous, the president saying he's going to show leniency, but reciprocal is just a euphemism for higher. America's biggest trading partners are going to see higher tariffs imposed on their goods imported into the U.S. Donald Trump has been complaining about the U.S.'s unfair trade relationships dating back to the 1980s, and that culminates tomorrow in a Rose Garden ceremony where he's going to settle some of those scores.
I mean, when he says he's promising to be kind, Roz, what exactly does he mean?
Well, that is the question. I mean, even if he announces tariffs that are not, it's not a blanket percent, but it's actually like depending on your country or whatever. I mean, as Brendan was saying, it's still increasing tariffs, and in some cases, potentially stacking tariffs upon tariffs upon tariffs. So these add on to other tariffs that are already in place or announced recently. And so you're getting a very complex soup here in terms of tariffs on certain goods, and that's a lot for countries to absorb and deal with and work out how to navigate. I mean, obviously he's got competing demands in himself in a way in all of this. He wants to show he's raising money, even though this is really more sort of an issue for US consumers who are paying more versus revenue raising. He needs to show some room to negotiate because he always wants to negotiate going forward. So this is the starting point perhaps for changes, but also he needs to show that he's being tough. So he's got all those competing demands. So where kind fits into that is a bit hard to know.
Yeah, and for market participants, I know there's a lot of noise and you have to, move away from that. But actually, what does the president want to achieve at the end of the day, Hugh? And will it be inflationary?
And that's the critical question about the objectives that are being targeted. If you go back to February when the first announcements were made on Canada and Mexico, this was about immigration, this was about drugs crossing the US border. In other words, it was about foreign policy goals, and therefore quite quickly we could get to the point where a deal could be struck, tariffs walked back, and markets were quite happy at the time to dismiss tariff headlines as a negotiating position and really bluster. What's changed in the past couple of months is the objectives that are being cited. So as Ros mentioned now, you have a broader goal to reshore manufacturing. You have the consideration around raising revenues, potentially in order to fund tax cuts later this year. And I think the most challenging thing for investors is that some of those goals are contradictory, right? You can't reshore manufacturing and raise lots of revenues, and therefore it's unclear how much of what we're going to hear tomorrow is a first negotiating stance or actually a tariff that's going to persist well into the latter part of this year, because your macro impact differs a lot.
But so Hugh, what do you think the North Star is? I know, there's a lot of talk again about the Mar-a-Lago Accord, which we talked about yesterday on TV. At the end of the day, does President Trump look at a lower dollar, or does he want a lower dollar, or what will be his, measure of success?
So a lower dollar and lower 10-year bond yields seem to be the two key areas of focus for this administration. Now, obviously, the extent to which you can do that without challenging the long-term growth prospects of the economy is a bit of a conundrum. But from my perspective, I think two things are clear about the US. This, A, clearly weighs on growth, and we're seeing that already in the CapEx intention surveys in particular, and B, it puts upward pressure on inflation. Now, the extent to which those two move is obviously the key challenge, but this is where you take Friday's labour market report, it becomes really significant, because for the Fed, at the moment, they don't know the difference between this growth and inflation shock, and it's likely the labour market data that would move them off the sidelines.
And then, Brendan, you have industries basically trying to carve out, their special kind of moratorium, U.S. car makers seeking concession for auto tariffs.
Yeah, exactly. So the auto tariffs for fully made cars kick in on Thursday. But for parts, there's another month of a lag for those to kick in. So the automakers are looking at both of those and saying we can absorb some of it, but all of it we can't absorb. They import components from all over the world, basically South Asia, North Africa, and so they're trying to make the case to the president that, look, if you don't give us an exclusion on some of this, then they're going to be job losses, they're going to be profit reductions, and really it's going to work counter to what you're aiming to do.
Yeah, and Ros, I mean, this is not an economic tool only, right? This is also a political tool. So could there be U-turns? Is there anything that leaders are now trying to do to soften the blow, or are they holding strong?
Well, you see a lot of leaders wanting to have direct conversations with the US, thinking maybe if they can just get in the room with Donald Trump or some of his senior officials, you get the right official, you get the right ear, and maybe you get some special treatment for yourself, be it Australia, the UK, the EU, or countries in Asia. But you also see the tough messaging coming, which is the EU even this morning saying, we're ready. If you come for us with reciprocal tariffs, we will come for you. I mean, the interesting thing is they're not necessarily retaliating straight away. They are giving themselves a bit more space, which seems to be a slightly different tactic, perhaps adopting the Mexico model of just sitting a bit quietly and letting Trump stew a bit before they respond. But so that seems to be one way that they're acting. But obviously, they're all trying to carve stuff out for themselves alongside key companies. I mean, Brendan just mentioned the auto sector, so you have a staggered approach. They have built that latency in where you get, first of all, it's entire cars, and then it will be parts. And so, again, Trump always leaving room to negotiate and to change his mind, because, again, that's how he operates, be it whether he's looking at these things through a foreign policy lens and using tariffs as a political tool there, or as an economic and market one.
Yeah, I mean, the other concern, and this took a lot of people by surprise, is that, there's a lot of U.S. chip giants now that are in limbo because of what we heard from Howard Lutnick pushing for bigger investments back home. Again, what does it mean for the industry, or in general, is there a question about U.S. exceptionalism that markets have to grapple with now, not wait 6-8 months?
It's absolutely a question for now. And you think where we started from at the beginning of this year, a very broad, crude consensus was that the U.S. administration was going to be brilliant for the U.S. economy and terrible for everywhere else, quite simply put. And so what we're seeing so far this year is question marks on both sides of that. You're seeing the exceptionalism of the US growth story clearly called into question at the same time as you're seeing actually a much stronger than expected policy response coming from other regions. And so when you look at how markets are moving, if the next leg of this is to start to put more pressure on the tech sector, that should be another factor that supports this rotation into international markets.
Yeah, but will it also play off, I guess, countries against each other? Is that part of, if you do a lot of uncertainty and make sure that leaders are kind of competing to grab your attention, then it makes it where everyone's worse off?
Well, that's what he's also very good at doing. We can see that even in Europe. So you've got Emmanuel Macron, the French leader, trying to build on his personal relationship with Donald Trump. We obviously saw that the leader of Finland really hit it off with Trump recently because they play golf together and managed to get a deal for icebreakers out of it for Finland. So they are all negotiating their own corner. The challenge for Brussels when it comes to the EU is to get that kind of European unity to hold everybody to hold the line, because each country in Europe is impacted differently by tariffs. So it's not as though one's better off, they're not all worse off or better off at the same. So they have a vested interest. If you're, obviously car makers in Germany, that's a real concern. And so you can see each leader is going to be trying to get the most advantageous thing for themselves, even if in theory they're negotiating as a bloc.
Yeah, and Brendan, I mean, it's quite a show. So we're expecting some big announcement. I'm sure a lot of leaders and certain market participants will be tuning in. It feels like a TV show.
Yeah, it's the Rose Garden, right? It's where you host astronauts who've come back from space, or you sign a peace treaty. It's a big ceremonial place symbolically. I'd be interested to see. We talk a lot about Canada, Mexico, and Europe. I'm curious to see how China is treated tomorrow. President Trump wants to do a deal with Xi Jinping, and how much pressure is he willing to put on Beijing to drive them to the negotiating table? Will we see another 10% tariff put on top of the 20% that's already there? That'll be one of the interesting things to watch tomorrow.
Because we haven't heard that much. I mean, it does feel like we've again, it's hot and cold actually, the relationship with China.
Yeah, as far as we know, the two leaders haven't spoken in any way that would in any substantive way since Trump took office. So. As Roz mentioned, Trump likes to put pressure on, put leverage on, to drive the other party to the negotiating table. So perhaps we'll see more of that tomorrow.
All right, thank you all for joining us. Of course, Rosalind Matheson, Brendan Murray, and Hugh Gimber from JP Morgan Asset Management stays with us. We'll talk a little bit about value in Europe as well. Coming up, the French far-right leader Marine Le Pen speaks out after being convicted of embezzlement, saying she's been silenced. We'll discuss the implications next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now we're back with Hugh Gimber, Global Market Strategist at JP Morgan Asset Management. Hugh, thank you so much for sticking around. We were talking and we're having a great conversation about some of the known unknowns that could hit tomorrow with Liberation Day, as Donald Trump called it. How do you build a portfolio around all of this uncertainty?
So diversification is the obvious answer, and that sounds like a lazy response. Everyone's going to talk about diversification being your friend. But I think the key difference in 2025 is that we're following 2 years where diversification absolutely did not work. You did not want to diversify, you did not want to consider valuations, you wanted to own US tech, regardless of all else. And so the difference about this year is that we're seeing diversification working really well again. So compare, for example, moves in European bonds and equities and US bonds and equities. In the US, you have the growth hit hurting stocks but helping treasuries, and you have the opposite playing out in Europe. And the same is true at a sector level. So that broad diversification is key. More specifically, when people talk about uncertainty, there's always uncertainty again. But the difference this year is that you're looking at an uncertain environment from both a growth and inflation perspective. So bonds are an excellent diversifier in our view against recession risk, but you also need to consider more the real asset side of the portfolio that can offer some protection if it's more of an inflation shock than a growth shock that we're ultimately facing.
Do you assume that every meeting from the Fed is now live?
I wouldn't go that far, because I don't think at the moment the labour market data has given them a clear enough steer. Conversely, for someone like the ECB, where the tariff implications are a much clearer growth shock than they are creating any inflation pressure, we see the ECB on a much smoother path back down to 2%, and then potentially further if it turns out that growth is really hit as a result of tariffs.
Hugh, when you look at equities, I mean, do you look like industry by industry? Again, we had the chip news this morning, which is putting a question mark on big tech in the US, or do you really look at regions, so Europe looking maybe a bit more attractive than the US on a simple valuation basis?
The two are one and the same. I think if you want to believe in that the European rotation has legs, you also have to be willing to accept that the tech story is now starting to fade. And that's exactly what we're seeing. It's no surprise to me that while we've seen this big rotation out of the US into Europe so far this year, you've also had tech and communication services, the two key underperforming sectors globally. So in my mind, the two are quite nicely aligned. We came into this year expecting to see a broadening of earnings growth across a wider range of sectors. That's exactly playing out so far. And you now have the policy catalyst coming through from greater fiscal stimulus in Europe, coupled with more supportive policy from the ECB. So you think about Europe really having suffered from monetary, fiscal and regulatory policy over the past couple of years. All of those things now seem to be working much more in Europe's favour. But
Europe, so away from automakers, I imagine, away from, I mean, is retail the place to be? Luxury also took a big beating because of China. I'm not sure what industry group has actually something really going for it.
I mean, take the banks as one example. Clearly, they've moved a long way in the past 12 to 18 months, but I think often when you look at financials, people will take valuations relative, say, a 10 or a 15-year average. And in that scenario, you're comparing the European banking sector to one of its most challenging periods on record. So just looking at a simple valuation today and saying, well, how do I stack up relative to 2014, it is clearly not fair. Similarly, in industrials, healthcare, we find many examples of excellent global companies that are still trading on a larger discount to their US peers simply because of where they're listed. So we finally now seem to have investors around the world waking up to the fact that Europe actually has some very good companies indeed.
Hugh, thank you so much. Hugh Gimber there from JP Morgan Asset Management. Now on to politics, and the French far-right leader Marine Le Pen has lashed out at the decision to bar her from running for elected office for 5 years. Now, Le Pen and her National Rally Party were found guilty of embezzling more than 4 million euros of EU public funds to finance party operations in France. She's told the French television that the decision effectively eliminates her from the 2027 presidential race.
I think the judges got it wrong. I think they chose to ignore all of the explanations that were given because in the very first hours of this trial, I had understood that the court was biased against us. I did not think that the magistrates would go this far against our democratic process and interfere this much with the choice of the French. Let's be clear, I have been silenced, but it's the voice of millions of French people that have been silenced as we speak tonight.
Let's get the latest now with Bloomberg's Caroline Conan in Paris. So, Caro, does this decision actually embolden the far right?
It is very possible, Francine, because Marine Le Pen, as you heard on this TF1 interview last night, appeared very defiant, saying that she's going to continue the fight, not even believing that she won't be able to be a candidate in 2027. She still believes she can appeal. She still has a very thin hope that the appeal would be pronounced before the presidential elections in April 2027, perhaps at the end of 2026. And when she was asked about whether Jordan Bardella would be a plan B, she clearly said that he is a great asset for the party, for the national rally, but it is too early to use him, as if she considered she could still be the candidate in 2027. So now you could think this is denial, or this is kind of a Trump strategy. Before Trump was elected in his second term, remember, he had a lot of criminal cases against him, and he used that to kind of galvanize his troops and say that the judges and the whole system was against him. We'll see what also that could mean for the parliament. Remember, Marine Le Pen remains an MP. She's just banned from running for office in the next election, but she's still in the National Assembly. Remember also the parliament is fragmented, and in December she played a very key role in making the former Prime Minister Michel Barnier's government collapse. So what comes next? We actually talked to one analyst from Teneo who said something very interesting, is that if the National Rally is framing this as a liberal conspiracy, perhaps they could actually double down with a motion of no confidence against the Macron's government. No one in the National Rally has talked about this quite yet, because I think the tone at the moment is really to talk about some kind of plot against the National Rally. But clearly, this could destabilize French politics over the next few months.
Caroline, thank you so much. Caroline Conal there in Paris. Now we're joined by Marta Lorimer, a politics lecturer at Cardiff University with the focus on European politics. Thank you, Professor, for joining us. So when you look at, the pretty incredible day that we had yesterday, will this make Marine Le Pen and her party even more popular, like we've seen in other countries?
Well, it's unlikely to make her more popular, but it is also not going to lose her many votes. And this is, I think, the main expectation that we have, is that the National Rally is going to stay pretty much where it is. Most of its voters won't really care about the fact that Marine Le Pen was declared guilty in this case, because at best they will think that it is okay to steal money from the European Union, and at worst they will believe that there is some kind of liberal conspiracy. I think it does make it a little bit more challenging for her to actually appeal to to a larger electorate, because if she goes with the victimhood card, then that might work, but part of the victimhood card requires her to be heavily anti-system, and that is something that in the past has kept the National Rally from actually getting into power.
Does it mean, if you look forward for the presidential 2027, a lot will depend, of course, on what kind of leader the RN chooses that's maybe palatable for the election. But what does it mean for the presidential race?
We're still very far away from the presidential race. I think one of the underappreciated thing of French politics is that talking about the presidential 2 years before doesn't really make much sense, because we don't know who is going to be running. And voters will make up their mind a little bit closer to the date. And this is particularly true this time around, because Marine Le Pen keeps saying that she's going to be in the running. That seems to be the party line that they are going with. Everyone is repeating it within the party. But whether that actually holds is an entirely different question. I think there are going to be people within the National Rally that say, well, listen, maybe we should start thinking about a plan B, and that could generate some tension. And then if the appeal doesn't arrive on time, then they're going to be scrambling to find a candidate 6 months before an election. It could work well for them. Emmanuel Macron appeared on the scene very close to the 2017 presidential election. But the National Rally, unlike Macron, is a party with a very long history. So they're more of a known quantity. And whoever they select as their leader will also be a bit more of a known quantity.
I mean, there had to be a big shuffle in legislative elections because of pressure from Marine Le Pen. Does this make life easier for Emmanuel Macron? Will we see fresh elections soon, or does it buy him time?
This is another one where, unfortunately, we don't really know because it could go both ways. On the one hand, it's in the National Rally's interest not to have an early election, because if they have an early election, then Marine Le Pen cannot run in it. And they have already been sort of countering this narrative yesterday when they started saying, oh, people think that this is going to make us less likely to vote a no confidence motion, but we're just as likely to do so. If it comes to a point where we have to do it, we are going to do it. This doesn't give us any certainty, of course, whether they are going to do it. But I think what might push them to try and avoid an early election is precisely the fact that I think they are genuinely in denial. They still think that Marine Le Pen will be able to run, and they haven't yet pivoted to the alternative strategy of saying, well, let's get Bardella to run as president, and then Marine Le Pen can run as prime minister.
Yeah, I mean, my understanding is that, all of this could still be suspended if there's an emergency appeal before the Constitutional Council that basically decides that voters' rights should prevail over the letter of the law.
It's still debated whether that is something that she can actually do. There's some discussion about whether this calling upon the Constitutional Council to actually give a ruling on this is something that is feasible. If it is feasible, then yes, they might be able to return a judgment. But once again, we don't know if it would go in Le Pen's direction. The Constitutional Council has already ruled in the past on this very law and has declared it constitutional. They might object to the fact that, that there's been a declaration that she couldn't run. But again, there's absolutely no guarantee that this would go in her favor.
Professor, thank you so much. Marta Lorimer, a politics lecturer at Cardiff University. Coming up, the UK braces for Donald Trump's big tariff announcement tomorrow. We speak to Lloyd Dorfman. This is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning,
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. Traders brace for more volatility on the eve of Donald Trump's Liberation Day, when the U.S. president is set to unveil his so-called reciprocal tariffs in the White House Rose Garden. France's Marine Le Pen says the rule of law has been violated after she was banned from running for office following her conviction for embezzlement. Plus, funding from the U.S. CHIPS Act is in limbo as Commerce Secretary Howard Lutnick seeks to renegotiate the terms. So the UK is expecting to be impacted by U.S. tariffs this week, despite ongoing talks to secure an exemption for British goods. It would be a blow for the Labour government, which has been trying to convince Washington that the trade relationship is balanced. Well, let's discuss all of this, how these trade tensions will affect the UK economy with Lloyd Dorfman, founder of the Travelex Group, the world's largest retailer of foreign exchange, which he started in 1976 from one small shop in central London. So, Mr. Dorfman, thank you so much for joining us. I mean, there's a lot that we need to talk about because you're also involved in the arts, media, and communication. But let's start with 2025 in the UK.
Okay.
When you look at all of these trade pressures, living cost issues, and everything in between with what the Labour government has been trying to put in place, how difficult would it be today, 2025, to be an entrepreneur in the UK?
Well, I think that the government have repeatedly said that they're very keen to promote growth, and promoting entrepreneurialism is absolutely the way to do it. I don't think it's difficult to start a business today. I think I'd like to see a bit more help from the financial community, particularly the banks. I'm not convinced that talking to regulators is the quickest way to promote growth. And, at the end of the day, to solve our economic problems, we've got to grow the cake. You can't keep cutting up the same size cake into smaller pieces.
But how do you grow? Because there's a laid-out plan from the Labour government, but we've also seen a lot of pressure from investors, which make it much more difficult, because this is a small, open economy that relies on the generosity of strangers when it comes to gilt buying.
Well, yeah, look, I think at least the one thing we have now is some sort of political stability, whereas, up until July, things were a bit of a roller coaster. So I think from that point of view, things have improved. But I think the government have, they've got to stop just talking the talk. They've got to walk the walk in terms of promoting growth. The budget, national insurance, that it's only going to result in job cuts and price rises, which is just not helpful. So I'm not seeing anything that is actually stimulating growth. They've got to go and do that. I think as an entrepreneur, I think it's never been easier to start a business. You can do it from your bedroom today. But I think in terms of financial support, mentoring, the banks, I think just that they need to be a little bit more supportive than I'm sensing they are.
Do you feel that a lot of people are leaving the UK?
I do. And this is a big worry. Anecdotally, I think I heard some statistic, I think something like 10,000 millionaires have left. That's a real problem. When I started work in the 1970s, we had something called the brain drain. Tax rates were, in some cases, 90% plus. And people were leaving because there was no incentive to work here in the UK. And I think at a time when they're trying to promote growth, to drive away the people who could be the engines of that is just counterproductive. And I think at a time, for centuries we've been a great mercantile nation. I sort of sense at the moment we're pulling up the drawbridge and somehow somebody's whispering in the Prime Minister's ear to say, well, let them leave, it won't be a problem. It'll be a problem.
It'll be a problem because of capital raising? This is millionaires that are mainly non-doms.
Yeah, but I think, but it's not just non-doms who are leaving. There are people who are selling businesses, running successful businesses who, just don't see a future here. And I think that it's not just about the non-doms, but I think we have to be competitive. People are paying 200,000 euros to go and move to Italy. I hear you can't buy a property in Milan because so many people are going to do that. Well, was it really difficult for us to come up with an equivalent, to update our own non-dom scheme? These are people who are, creating economic activity, leading businesses, but it's not just about non-doms. I'm aware of people who are selling up and going.
Yeah, I know you're very involved as chair of the Royal Opera House in the arts and also education. Do you worry about the arts, that there's not enough going on, actually? There's not enough support from the government because of lack of money?
Yes, yes, and yes. The Opera House, which I have the privilege to chair, is the largest employer of creatives in this country after the BBC. One of the preeminent performing arts organisations, not just in this country but in the world. The whole sector is sort of on the ropes at the moment. The Arts Council budget is £450 million, and it's important not just because of the importance of arts, but in terms of the economic contribution of the arts sector. In the broader sense, I think it's in the order of something like 130 billion. And then from a soft power point of view, we're not world leading in many things these days. We happen to be really good in the arts and culture sector. So, I really worry that the government don't fully understand the economic engine that is the arts sector, how important it is, certainly from a sort of educational point of view, young people, mental health. It's much broader than just DCMS. It makes a big contribution to creative skills, how they're applied and transferred across so many other sectors. So, this is a jewel in UK PLC, and I think they need to sort of wake up and understand how important it is.
But what's the right way, again, to fix it? Is it just, government funding? Is it getting closer to Europe to help with visas, also for artists?
I think the visa problem is a huge issue. And yes, government funding, we've just had a tiny increase, which is like just over 1%. It's the first increase we've had for something like 7-8 years. Between government funding and tax relief, it's really helpful. But I think they should really get behind it and see it as an engine of growth which they need to promote further. And, not just we, the Opera House, face big challenges, but across the whole sector. And also there's this tendency to look at sort of one size fits all. Grassroots is important around the country, but, you need to respect and nurture the totemic institutions. It's not, one size does not fit all. The sports world gets this right. Grassroots sports, elite sports activities, they get it right. They need to do that for the arts sector.
Tomorrow is a big day because of this Liberation Day, so-called Liberation Day that Donald Trump has announced because of trade and tariffs. How much will that complicate the UK's life?
Enormously. I don't get it. Since 250 years ago, Adam Smith, wrote his Wealth of Nations and said that free trade was the ultimate way to promote economic growth. I understand Donald Trump is a deal maker. In my experience, the best deals are win-wins. This is going to be a lose-lose. This is going to restrict economic growth. It's going to stoke inflation. It's going to discourage investment. It's going to result in escalating trade wars. And, I understand that I think the OBR are estimating that it could impact our economy by the order of something like 18 billion. So I don't see it as Liberation Day. I see it more as Protectionism Day.
But so what's the way forward? And again, it's unclear whether President Trump wants a deal, whether it's a way of getting money back in the coffers of Treasury. How does Keir Starmer deal with this?
Well, I think my sense is actually his approach at the moment is actually the right one, not to have a knee-jerk, immediate retaliatory response, to feel the way through it, to see if we can negotiate a trade deal, but it's buckle up time. It's going to be tough.
But do you think allies cannot rely on the U.S. like they used to? And what does it mean for businesses? Do they need to look further east? Is China a viable alternative?
So I've recently got involved I'm chairing a new independent institute for strategic communications. We're doing work with governments around the world, with NATO, and there are concerns in Europe, obviously, about the Russian threat, in Asia with China, and I think that the importance of understanding and achieving big discourses, changes in mindsets. This is an important thing to be doing, and particularly, we're looking to apply that to the commercial world as well.
But I guess the problem if you're a chief executive right now is you see all of this news. Hopefully you're watching Bloomberg and you say, I don't really know what to do with it. Let me spend a little bit less until I figure it out. So is there a worry that the economy just seizes up because of the uncertainty?
Well, absolutely. I mean, I just said just before, at the end of the day, it's going to discourage investment because of the uncertainty. Yeah. I think chief executives, are going to have to have to choose their markets. Yeah. I think, the U.S. needs to be careful, that it doesn't end up destroying its brand. To be the biggest, solid, most dependable country in the world, it's doing a very good job at undermining all that, and restoring that reputation will take a long time. And I think I'd always thought that with power comes responsibility, and with that responsibility, it's an obligation to act with humility and in a humane way, and for the haves to help the have-nots. To use economic and military power in a sort of stick-type way ultimately will be very damaging, I think, to the United States.
Is this, I don't know what it means for the UK, is there an opportunity for the UK to, it can't really fill that void because of the size of the country, but to be a link?
I think, Britain is hugely respected for a number of things. And I'm seeing this actually again in the strategic communication area, where countries are coming to us because we're seen as very good at this. I think, I actually think Trump was correct in calling out the European defence thing. I mean, this was a wake-up call, and I think, Europe had been taking advantage of the situation for some time, so I think that's been a good thing. But I think generally, it's forced Europe to address its defence requirements. It's sort of encouraging cooperation, and perhaps, as we watch the geopolitics, the sort of tectonic plates of which are not just shifting, they're sliding, I think this will create new alliances and new opportunities.
Thank you so much for joining us. What a wonderful conversation with Lloyd Dorfman there, the founder of Travelex. Now, let's also turn to one of our tech scoops this morning. We'll get back to, of course, geopolitics and tariffs, but Bloomberg understands the Commerce Secretary, Howard Lutnick, could withhold subsidies that have already been agreed under the U.S. CHIPS Act. Now, President Trump has called on Congress to repeal the law. Bloomberg's Tom McKenzie is here with the latest. So, Tom, what exactly is the strategy here? Because a lot of people were really taken by surprise.
Yeah, Fran, so you'll remember that the CHIPS Act and Science Act was signed in 2022, and it allocated $52 billion in terms of grants and subsidies to chip companies, semiconductor companies, to boost their investments and build out things like foundries in the US. The Commerce Secretary, Howard Lutnick, looking basically to squeeze more juice from the orange, looking to withhold some of these subsidies to compel those companies, whether it's Intel or Samsung or Micron and others, to ramp up their investments in the US without additional grants. So there's a stick approach, which is withholding some of these subsidies, and also, of course, President Trump's own threat of tariffs on the semiconductor industry. That's the stick. On the carrot front, we are hearing from our reporting that Howard Lutnick, the Commerce Secretary, is also open to considering increasing and pushing out a tax credit of 25% for these companies that actually has proven to be more valuable than the subsidies themselves. So that is the reporting in terms of how they're looking to adjust this. Some of these companies have already, of course, pledged to spend, and part of this seems to be down to, as well, trying to build a template on what TSMC have done, of course, the owner and operator of the biggest foundries over in Taiwan, who recently committed to an additional $100 billion of investments in plants in Arizona. And that seems to be part of a template that the Commerce Secretary is looking to use as he wants to drive up, of course, the investment numbers and the dollar numbers that he can then hand over to President Trump and they can claim as a win.
So could a more hardline approach, by the U.S. to subsidies actually boost China's standing in the chip race?
Well, as you were just discussing with your previous guest there, Fran, it's a question of certainty or uncertainty and predictability. The CHIPS Act was a bipartisan piece of legislation signed in 2022 with the backing of both Democrats and Republicans, and now you have a new administration trying to rework that piece of policy. So there's the uncertainty that in some quarters will be a reminder of the unpredictability and the risks around investment. You do not have that 10-year horizon, arguably, that you once had with that CHIPS Act. Some of these companies were on the line already to receive subsidies of about $1 billion, including the likes of Intel, Micron, and Global Foundries. Some of those companies have not received the funding that they'd had agreements with the previous administration to receive. That funds haven't come through. Other companies are still waiting to have the talks and discussions with the Commerce Secretary. So that uncertainty is a potential risk. These companies, by the way, have already committed to investing about $400 billion in the US market as a result of the CHIPS Act. So there is potentially a question as to whether or not that commitment now starts to be put into question.
Yes, so many questions. Tom, thank you so much for the terrific briefing. Tom McKenzie there with chips. Now, the AI startup Builder.ai has lowered the sales figures it provided to investors and called its auditors to examine the last 2 years of its accounts. Well, the company has cut revenue estimates for the second half of 2024 by about 25%. Multiple former employees who've asked not to be identified have alleged that Builder.ai inflated sale figures. Now, the CEO has said that discounts given to customers may account for the discrepancies. And SoftBank is said to be seeking a loan of as much as $16.5 billion to help fund AI investments in the U.S. The bridge loan under discussion has a tenor of about 12 months and may help SoftBank lead a $40 billion funding round, which OpenAI has just finalized. Well, coming up, UBS CEO Sergio Martin was the highest-earning CEO across continental Europe's biggest banks last year. Details next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
So many Europeans feel utterly disheartened by the announcement from the United States. Let me be clear, Europe did not start this confrontation. We think it is wrong. But my message to you today is that we have everything we need to protect our people and our prosperity.
European Commission President Ursula von der Leyen there speaking ahead of Trump's reciprocal tariff plan expected to come tomorrow. Now, German inflation slowed more than anticipated in March as European Central Bank ponders whether to lower interest rates again at their next meeting on April 17th. Now, this comes as UK food inflation hit a 9-month high, adding more pressure to the government. Well, we're now joined by Jamie Rush. He's Chief European Economist with Bloomberg's Economics. So, Jamie, a lot in there. There's UK inflation, then, of course, there's what the ECB is doing. Who has it harder?
Well, I mean, I think the Bank of England has the harder choice in the sense that, you know, wage growth is too high. It's very difficult for them to decide whether they should be cutting and indeed when they will be able to cut. I think for the ECB, I mean, if you look at the data, what would we be saying if we didn't have this conflict going on the trade front? We'd be saying, well, interest rates are now pretty low.
Yeah.
Inflation's broadly heading in the right direction, but still a bit too high.
Yeah.
And so now would be like a good time to pause, take stock, and think about, you know, what actual further measures need to be taken. Remember, like, unemployment's still very low as well. So I think we would be saying that now's the time to pause. You know, Trump's probably got different ideas, and when we look around the possible impact of tariffs, I mean, I think it's pretty clear that the impact on demand in the economy will be very large for the year.
Yeah, and actually, Bloomberg Economics, and I love the work that you and the team do because it kind of breaks it down, and it's very, you know, similar. We don't really know what President Trump is announcing tomorrow on, you know, the so-called Liberation Day, but run us through some of the impacts on inflation, on growth, and what that means for ECB scenarios.
Yeah, so I mean, I think, you know, we look at Trump's trade policy through the lens of the different grievances he has with the EU, right? So he thinks that VAT rates, that they're an export subsidy, so he wants to tackle that. He thinks non-tariff barriers are too high, so, you know, the rules and regulations in the EU are too onerous for firms. He doesn't like digital services taxes. He doesn't like low defence spending. I mean, there's no way that the EU is going to be able to address all of these gripes, right? So, I mean, if we add up some of these grievances, we can easily imagine that you could get to a tax rate of around a tariff rate of 50%. I don't think you'll go that far. But, I mean, if you're saying 50 is the maximal, 25% suddenly seems reasonable.
Yep.
So I think we could end up there. And what would that do? Well, you're putting it something between 1.5–2% of GDP at risk in the Eurozone. The immediate impact could be inflationary if the EU
That's a nightmare
responds.
for the ECB to figure out.
Exactly right.
Right, because you have this pull inflation and GDP pull.
Yeah, but I imagine that the argument that will win the day is that the demand impact will trump the inflation and potential consequences. Remember, the EU is going to be clever about it. They're not going to pick things that are going to have huge inflationary impacts. They're going to try and minimise the impact on European inflation. So for that reason, I think, you know, demand would be the thing they would focus on, and that brings you towards a world where the ECB has to cut in April and probably has to go a bit further than it otherwise would have had to.
Okay, so interesting. Jamie, thank you so much. Jamie Rush there from Bloomberg Economics. Now, Sergio Armati of UBS was the highest earning chief executive across continental Europe's biggest banks last year, while UniCredit's Andrea Orcel got the largest raise. Let's speak to Bloomberg's Steve Ahrens, who's been looking at the numbers. So, Steve, good morning. Who are the biggest or the big European bank winners last year?
Well, I mean, Orcel got the biggest raise, definitely. I think, if I remember correctly, it was 32% up. I mean, much of it in equity, long-term incentive plans, so the value would fluctuate depending on the share price, but still, it's a steep rise. I think the second one was Hector Risi at Santander with, I think, something like 22%, and everyone else was below that, but Armati is still the best paid.
So how will future interest rates actually, you know, cuts affect some of the bank profits, Steve?
It's actually a positive story right now. It's surprisingly, and that's why the bank stocks have rallied so much in the first quarter of this year. Everyone was expecting that bank profitability has peaked because the ECB has started cutting rates, but there's so much going on. Loan demand is increasing, and fee income from asset management, investment banking services, and wealth management is rising pretty rapidly. So it seems like banks will actually be able to defend their level of profitability or even increase a little more, and that, of course, will be good for pay as well.
Yeah, Steve, overall, I mean, you run a team that basically follow this day in, day out, looking at European banks versus Wall Street. I guess they have benefits, but regulation is one of the big question marks going forward. What are some of the lines of questioning that you'll be looking out for these chief executives in the next 6 to 8 months?
You're right. I mean, there's right now actually a big discussion in Europe, I mean, across the globe, triggered by sort of deregulation push in the U.S. that has now been affecting the European discussion. And there's a lot of deregulation going on in the European Union as well. There's new sort of debates on what to cut, and sustainability regulation will be one area where we'll see relaxation. And there's also a question about actually executive pay. In the EU, there's a cap of bonuses for top management of twice their fixed pay. The UK recently, because it have left the EU, has scrapped that bonus cap, and UK banks have been benefiting from that. And so there's a discussion in EU, or at least EU banks pushing for something similar in Europe.
Yeah, Steve, I mean, when it comes to banker pays, again, will this get a lot of splash? Is there going to get a lot of public outcry like we've seen in the past? Or have things changed on that front?
There's always outcry in the European Union over high and what some people say excessive bankers' pay. There was a sort of a renewed discussion around Motti's pay when it came out. Orgel's pay has been in the limelight, and UniCredit has been making a strong effort to defend the pay, pointing to company performance and benchmark comparisons. There's always discussion. It's at the same level as always, and I think the banks will be able to sort of just sit it out.
Steve, thanks so much. As always, Bloomberg's Stephen Ayers there, of course, who oversees all of our European banking coverage. Now, this is a picture for U.S. stocks. Futures actually retreating. Gold extending some of the winning streak as the arrival of U.S. tariffs is looming over the markets. Now, investors continuing to snap up haven assets, sending gold to a new record high, knocking the 10-year Treasury yield lower. Now, the president's upcoming announcement on tariffs have definitely created uncertainty, leading some investors to be cautious, but also strategists to lower their estimates. If you look at some of the things that we're watching out for, look, I thought it was very telling that Goldman Sachs strategists cut their forecast for Europe's stock 600, following a pretty similar move from the U.S. team. The team led by Sharon Bell trimmed the 12-month target on the index to 570 points from 580, again, citing weaker growth forecasts. Now, the former U.S. Trade Representative, Catherine Tai, is on Balance of Power later. Catch that conversation at 10 p.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.
And Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Good morning from our global headquarters in New York. I'm Shonali Bassick in for Danny Berger, and welcome to the Bloomberg Brief, and let's set your agenda for today. U.S. stocks are wrapping up the first quarter, trailing the rest of the world by the most since 2009. The rout continues as Tariff Day looms. And the CHIPS grant is in limbo. Commerce Secretary Howard Lutnick may withhold CHIPS Act funding to push firms to expand U.S. projects. And SoftBank is said to be seeking as much as $16.5 billion to fund AI investments in the United States. But first, let's get a check on markets here in the United States. We are seeing futures trying to take a breather here, briefly up, but really flat for the S&P 500. NASDAQ getting a little bit more of a lift by the tune of 0.1%. Russell 2000 just as flat. You are seeing bonds, however, still getting a bid with the U.S. 10-year yield firmly below 420, now at 417, another 3 basis points lower on the day. The 2-year down by 1 basis point. I also want to take a look here at Eurozone CPI because preliminary March core CPI rises 2.4% year over year. The estimate was 2.5% year over year. And of course, preliminary March consumer prices have risen 0.6% month over month, while March consumer prices have risen 2.2% year over year. You are seeing a bit of a reaction here in the euro, but not by much. It's still hanging out at about 1.08 against the dollar. We're also now going to move on. We're going to keep an eye here on the top headlines of the day, including Live Nation, because President Trump signed an executive order on Monday aimed at cracking down on ticket scalping and fees that drive up the cost of attending live events. And there's Newsmax. Newsmax is extending post-market gains after closing with a 735% surge on its trading debut on Monday. The conservative media outlet raised $75 million in its IPO. And finally, Johnson & Johnson, a federal judge rejected the company's third attempt to use bankruptcy to set up a trust fund to pay women who claimed they got cancer using the J&J baby powder. And we're going to turn back now to markets because joining us now, BlackRock's Vasiliki Petratoridi, of course, to react to what's happening in Europe, what's happening here in the United States, the relative value to find amid it all. You're looking at that tremendous bid in the bond market, particularly here in the United States. Does that make sense to you?
Good morning, Sonali. Thank you for having me on this. So, actually, it does not. I think where we are, obviously, now the big event for markets is the reciprocal tariffs that we are expecting tomorrow. And it is important to kind of level set and say that tariffs are going to be a permanent feature in this U.S. administration. They're here to stay. Of course, a number of different rates will be applicable. Some countries, different sectors will get different rates. But ultimately, we do expect the average U.S. tariff to land somewhere in the region of 10%. Tomorrow is going to be a big day, not a clearing event. There are going to be more questions, more uncertainty, more negotiation to come. But what it means for markets, actually, we think rates are going to edge up higher. Actually, the opposite of what we're seeing in U.S. Treasuries year to date and in the last couple of sessions. And we also think that we're going to continue to see rate-induced volatility. And what it means for portfolios is we continue to emphasize the importance of income, generating diversified, consistent, and high income, as opposed to relying on interest rate risk that arguably is not going to be a good diversifier in portfolios today.
Do you feel the same way about euro area bonds at this juncture as you do about U.S.?
This is an interesting question, Sonali, because obviously up until last year, duration was your friend in Europe. And this year, with the other big policy shift that we're seeing in Europe, with the German fiscal spend kind of announced, we think that Europe has the potential to face a similar situation with the US in the regards that we do expect Eurozone government bond rates to edge up higher. This is on the back of the fiscal spend, on the back of fears around growth and investors requiring more compensation for owning long-dated bonds. So a bit of a shift, but of course the ECB is on a different path. I mean, we saw obviously the inflation data this morning pretty much in line with expectations. Inflation is less of a concern, but obviously kind of fears around tariffs, growth, economic data are weighing on the ECB, and we're seeing probably April cut coming back on the table. We expect 1 to 2 cuts from the ECB this year, but definitely coming up to the end of their rate cutting cycle. But in terms of positioning, what do we like? We like front-end yields, but more importantly, we like European credit.
Now, what does this mean for your expectations also for U.S. rate cuts? Do you believe that the Fed will be able to achieve at least 2 or even 3 as the market has been pricing in more recently?
Yeah, I mean, the Fed obviously cannot act preemptively on kind of tariff-induced inflation. They cannot act preemptively on growth fears. And they're somewhat constrained in what they can do. Obviously, inflation is still kind of a sticky point. They could react, obviously, if they see a deterioration in the labor market. But I think to my earlier point, I mean, the hard data are still not painting the picture that the bond market is painting, which is a picture around kind of recession and the expectation that the Fed is going to step in. They will not, and that's why we continue to be positioned at the front end of the curve when it comes to U.S. Treasury rates. And this is when looking at bond ETF flows as well. The majority of flows this year has been going into treasuries and broad market exposures. But as I said earlier, we do want to continue emphasize income generation in portfolio as opposed to pure interest rate risk.
Yeah, to that end also, you look at the U.S. 10-year, and we are pretty far away from the nearly 4.3% that we saw just a little bit earlier this year, just really weeks ago. We're at 4.17 right now. What do you make of fair value on the 10-year? It's pretty stunning to see both investors get concerned about tariffs, potential inflationary pressures, and see the 10-year bid down this drastically with the fear around growth.
Yeah, I mean, I think if we continue to see that level of kind of yield rally in the U.S., at some point, I wouldn't be surprised if investors see that as an opportunity to reduce exposure to U.S. Treasuries and shift more into, as I mentioned earlier, into kind of parts of the market where they can rely more for carry. And we definitely, this is what our preference is. This is where our strategies in fixed income focusing right now. We just launched our first actively managed fixed income ETF in Europe that is focusing on generating income through a variety of sectors. And I think that's also what's important right now, to take opportunities across the universe of fixed income exposures. Corporate bonds, high yield securitized assets, floating rate bonds, because the U.S. Treasury market is going to face volatility and challenges ahead.
Vasiliki, when you're thinking about owning credit, especially across Europe, what is heavily exposed, though, to tariff threats? Presumably, there are many companies that will feel the pain.
Yeah, I mean, when we think about tariffs per se, I mean, tariffs, they will have an impact on companies' profitability, but I don't see the tariffs having an impact when it comes to kind of rising default rates, for example. So in that regard, I see very few things becoming contagious for European credit right now. Obviously, spreads are tight, but as I said earlier, carry is still very attractive. And credit has gone through a lot the last couple of years, and they have really powered through in the way they have restructured their debt, in the way they responded to geopolitical events. So we really kind of believe that it is a good place to be, staying at the front end of the curve, but also something very interesting about the European credit market is we're seeing euro curves steepening, which we haven't seen since kind of pretty much the Q3, Q4 of last year. So that kind of ability to generate more income as opposed to sitting in cash, it's an interesting point, and that's why we're seeing investors stepping into fixed maturity funds and ETFs where they can lock in that yield but still have funds available if they need to take risk off, and that's why we've seen more than 7 billion going into fixed maturity ETFs year to date.
BlackRock's Vasiliki Pachatoridi, thank you so very much for joining us this morning ahead of what Trump is calling Liberation Day. Of course, a lot of tariff news will be hitting the tape. Now, to other top stories trending on the terminal this morning, U.S. automakers are making a last-ditch effort to sway President Trump to soften those incoming tariffs. Bloomberg sources say that Ford, General Motors, and Stellantis are lobbying the administration to exclude certain low-cost car components, such as electric wiring. And President Donald Trump signed an executive order aiming to crack down on ticket scalping and fees that drive up the cost of attending live events. The order is similar to former President Joe Biden's move that targeted junk fees and pushed transparency in ticket pricing. And Goldman Sachs has drawn more criticism for the $80 million bonuses that it plans to give the bank's top two leaders, David Solomon and John Waldron. Institutional Shareholder Services, a proxy advisor, is urging investors to reject the awards at an annual meeting. Coming up, the arrival of Trump's tariffs looms over global markets, the latest on the president's plans. Next, this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
Now, President Trump is set to unveil his reciprocal tariff push during an event at the White House Rose Garden tomorrow. But the extent of the levies still remain unclear. We're going to bring in Bloomberg's Oliver Crook for more. Ollie, what are we expecting tomorrow? Have more details emerge? Do we know if kind of the worst imagined from investors, universal tariffs, are seriously on the table?
So I think there is certainly the possibility of universal tariffs in terms of hitting all the sort of specific countries with these so-called reciprocal tariffs. I mean, as far as the Europeans are concerned, you really have to think about the industries that are most effective. And we should remind people that the EU and the U.S. trading relationship, it's worth about $1 trillion every year, and there's a trade deficit in the favor of the European Union of about $200 billion. What we do know that we're going to get tomorrow is these auto tariffs and the tariffs on the pharmaceutical sector. And when you think about the exports that come here from Europe and go over to the United States, 23% of those are pharmaceutical, 10% of that are the auto industry. So it's going to be very front and center. I think what the Europeans are really going to be looking at, however, is basically the methodology of how the Trump administration is looking about this. Is this just about closing this sort of trade gap that exists on various goods and items, or are they going to be bigger about it? Are they going to think about things like value-added tax? Are they going to think about other ways that they might want to impose their own policies on European policymakers? And that is what they need to prepare for. And we heard from Ursula von der Leyen, the president of the European Commission, just about an hour and a half ago. Have a listen to what she had to say.
So many Europeans feel utterly disheartened by the announcement from the United States. Let me be clear. Europe did not start this confrontation. We think it is wrong. But my message to you today is that we have everything we need to protect our people and our prosperity.
I think it's notable that they're not moving with excessive haste. They don't have their list out yet, but they're really prepared for a fight if they need to fight it. And it seems like, I mean, we'll find out tomorrow at 8 p.m. our time from the Rose Garden tomorrow. The European policymakers are really bracing for, potentially a trade war, but we'll have to see.
Let's also move on to talk a little bit more about geopolitics as well, because we did see President Trump dial back his criticism of Russian President Vladimir Putin, and instead he had accused Ukraine of attempting to renegotiate an economic deal with the United States. What is the latest?
Yeah, what I think is really interesting about all of these is it's hard to sort of disentangle all of these things for European policymakers because they have all of these issues that they're dealing with, whether it's the trade war with the United States, they have the war in the Ukraine, they really need the United States on side for that as well. So, all of these sort of policy issues seem to sort of come together. What we heard from the president over the weekend was after an interview that he had with NBC on Sunday saying that basically, his words, that he was very pissed off with Vladimir Putin because there seemed to have been some indication that Putin wanted to remove Zelensky, wanted to put Ukraine under sort of a UN temporary-led sort of government in the interim for an election, and basically Trump saw this as basically a stalling tactic and basically trying to get out of the deal. Then we heard again from yesterday, and again, the Trump position on this has been very clear from the beginning. They're really very concerned with getting a swift end to this war, and then he sort of softened that stance a little bit, saying that Putin seems to be wanting to go in the right direction. But again, with so many of these things, until these conversations actually happen, it's very hard to get a read of what's going on in the background. Though, Shonali, something that I will sort of push us all forward to a little bit later this week is we have this EU and NATO leader foreign ministers meeting that is happening in Brussels. We will have Secretary of State Marco Rubio here. It'll be very interesting to see what the messaging is from the Secretary of State, particularly after those signal chats, and we had sort of some of the views of the Trump administration on the Europeans, but really sort of what the future of NATO holds really in the balance at the moment.
Absolutely. I'll be looking forward to that Rubio readout. That is our own Oliver Crook. Thank you so very much. Now, coming up, a look at what else is making headlines around the world. Stick with us. This is Bloomberg.
case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
This is the Bloomberg Brief, and I'm Sonali Basak in New York. Time now for our front page news, a look at what's making headlines around the world. First up, on the Wall Street Journal, the leader of France's National Rally Party and the favorite to win the next election, Marine Le Pen, has been convicted of misusing EU funds and barred from running in the 2027 presidential elections. President of the party, 29-year-old Jordan Bardella, has said he would run for president if Le Pen has asked him to. Next up, on the Washington Post, the Trump administration is targeting billions of dollars in federal funding to Harvard. That includes $255 million in contracts between Harvard and all of its affiliates, as well as $8.7 billion in multi-year grant commitments to Harvard and its affiliates. And on Bloomberg, Commerce Secretary Howard Lutnick is signaling that he could withhold promised CHIPS Act grants. Bloomberg sources reveal that Lutnick is pushing companies in line for federal semiconductor subsidies to substantially expand their U.S. projects. For more, we're going to bring in Bloomberg's Tom McKenzie joining us now. TSMC, NVIDIA, they've all front-run this with investment talks, huge ones here in the United States. Now, which companies might be on the hook?
Yeah, Sonali, absolutely. Look, TSMC came through with that, $100 billion of additional investment on top of investments already committed to the US market. And certainly it seems like the Commerce Secretary, according to our reporting, is looking at TSMC as a case study in how to extract greater investments and more commitments from these semiconductor companies and using leverage within the CHIPS Act that was signed in 2022 to do that. So from our reporting, what we're hearing is that the Commerce Secretary wants to and is considering withholding shifting some of these subsidies to some of the companies on which some agreements have already been made in terms of the funds around the CHIPS Act to ensure and to try and pressure them, essentially, to ramp up their investment by tens of billions of dollars. That's the stick approach. The carrot approach is that the Commerce Secretary is also, we're hearing, considering expanding the credit, the tax credit that on many metrics is actually more valuable to these companies. 25% tax credit. He is open to expanding that tax credit. That would need Congress and congressional approval, but apparently that is a possibility. So the carrot and stick approach being taken by a Commerce Secretary who clearly wants to ramp up the investment numbers from semiconductor companies that have already committed under the CHIPS Act to about $400 billion worth of investments in terms of building out their footprints, whether it's foundries or R&D in the US.
Now, I want to stay on chips for a minute here, but go internationally. China, Japan, South Korea have all agreed to work together to maintain their chip supply chain, and that is in the face of impending tariffs from the United States. What do we know?
It's pretty fascinating development, isn't it? And there's still a lot of detail that needs to come through, but the fact that these three countries with their historical enmity have sat down together to talk about supply chains, to talk about having a deeper dialogue around export controls, and potentially also a free trade agreement at some point in the future is an indication of how the tariff regime emanating from Washington is having global impacts, even on countries that, again, historically have had huge and deep underlying tensions. And those tensions remain, of course, not just between China and Japan, but between Japan and South Korea as well. So the three sitting down, potentially looking at easing the supply chains. They need each other ever more, given the potential impact of those tariffs that Trump has suggested he would hit the semiconductor industry with. You've got companies like South Korean companies looking to ensure that they have the raw materials from China, and China, of course, looking to ensure it still has access to some of the semiconductor machinery and chips that it's still able to import.
I want to zero in on Japan, particularly SoftBank here, because when it comes to the gobs of money that are planned for U.S. investment, they are seeking now a record loan for that growth in the United States. It's a $16.5 billion loan they're seeking. How do they intend to drum this up? Is there going to be huge demand?
Yeah, quite the gob of money, as you say, Shanali. Look, this is something, of course, Masayoshi-san is quite familiar with. It would be their biggest loan that they've had. But, of course, he's pretty used to going to the banks in Japan and internationally raising funds to put to use in his big bets on some of these key themes. And Kitley, he has been going all in on AI, leading, of course, that pledge around $500 billion of investments in data centers and infrastructure as part of Stargate, alongside, of course, Oracle, OpenAI, and MGX of the Middle East. So we're looking at $16.5 billion. That's what we're hearing in terms of reporting, in terms of this loan size. Part of that could be put to the $40 billion in terms of its investments into OpenAI. Part of that investment round that OpenAI has announced with that $300 billion valuation, part of it as well into that $500 billion, part of that move towards that $500 billion worth of investments as part of Stargate. Interestingly, the credit agencies in Japan and S&P as well have come out and suggested that this could weigh on the profile, the credit profile of SoftBank going forward.
Yeah, the outlook put to negative. A fascinating story. Bloomberg Daybreak Europe anchor Tom McKenzie, we thank you so much for your time this morning. And coming up, we're going to catch up with Kevin Mann of Hennian and Walsh. That's next. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes out in this discussion is in the crypto area, where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
From our global headquarters in New York, welcome to the Bloomberg Brief. I'm Sonali Basak, in for Danny Berger. Let's set your agenda. Now, U.S. stocks have wrapped up the first quarter, trailing the rest of the world by the most since 2009. The rout continues as tariff day looms. And the CHIPS grant in limbo. Commerce Secretary Howard Lutnick may withhold CHIPS Act funding to push firms to expand U.S. projects. And SoftBank is said to be seeking as much as $16.5 billion to fund AI investments in the United States. Let's get you in on the check of the markets because you're looking at futures trying to catch a bid in the S&P 500, basically flat on the morning. NASDAQ futures, though, riding a little higher, up about 0.2%, though the Russell 2000 roughly flat. The bid in the bond market has continued, and the 10-year yield has stayed firmly below that 4.2% level, hanging around 4.18. The 2-year roughly flat on the morning at 3.87. We're now going to bring in Kevin Mon. He's the president and CIO of Hennian and Walsh Asset Management. That bond market move has been pretty stunning relative to the stock market move.
Certainly has.
It looks like if there's something to buy, people are going straight to the bond market. But should you face inflation, this is where my question is. Does that move make sense to the tune that we're seeing it?
Yeah, I think a lot of investors are happy to see March end and the first quarter be behind us. It was the most difficult March and first quarter since 2022, as we've seen a return of volatility that was largely absent in 2024. In fact, in 2024, the market moved by 1.5% or more lower on a given trading day, just 4% of the time. Thus far this year in 2025, that's quadrupled to nearly 16% of the time. That's significant volatility. So investors are fleeing to safety right now, or in some situations, going to the sidelines completely. And as we know, I've been doing this now for well over 3 decades, you can't time the market. It's more important to be in the market than it is to try and time when to get out of the market and get back in. But it's an indication of where investor sentiment is right now leading into the second quarter of the year.
Right. I mean, you look at the S&P 500, and it had been hovering around that 5,500 emotional barrier, if you call it that. You have seen others like JP Morgan call a low of as low as 5,200.
Yeah.
Where do you believe the low is?
I think all of the bad news is priced in at this point in time. And if I could use a basketball analogy, since we're within March Madness right now, I'm going to create a final four of factors that I believe could take place in the second quarter of this year and could lead to a stronger second half of the year. First, tariffs and trade. Now, I don't know where we're going to end up with tariffs. We're going to learn more tomorrow in terms of how reciprocal those reciprocal tariffs are. But once we know what the tariffs are, investors and business owners can plan accordingly. 2, the Federal Reserve indicated just last week they stand at the ready to step in if the economy deteriorates further. And I believe that that first potential rate cut of 25 basis points may still be on the table for June of this year, if, in fact, we get an extension of those job or tax cuts. If we don't, that could amount to the largest tax increase in our country's history. And then finally, the last factor, and perhaps most important factor, continued investment and continued spending related to both defense and AI infrastructure.
You know, I can understand why investors want to move on and start talking about taxes now. Yeah. It's a huge thing to look at around the corner. But how do you factor in just how to think about tomorrow? It was the point for a while here that investors thought April 2nd would start to reduce uncertainty. That notion's starting to go away pretty quickly.
Yeah, the only thing that's certain right now is that there's going to be more uncertainty. At least we'll learn more tomorrow about, again, just how reciprocal those reciprocal tariffs are, what countries, what goods and services will be impacted, and perhaps we'll get some indication about what may be coming down the road. That's incredibly important to investors as it removes at least one element of uncertainty. It's also important to business leaders as well, as they need to plan accordingly.
But how do you move your portfolio around the tariff decisions in particular?
So I would look at the underlying themes that are in place regardless of tariffs, also factoring in the potential impact of tariffs. So I think about what themes are really generating market returns leading into all this tariff talk. And I go back to defense spending. For one, a lot of people thought DOGE was really going to cripple defense spending. It certainly has brought down the Department of Defense, but we continue to see more contracts being signed with the likes of Boeing and Lockheed Martin. And then we're learning overseas that the European Union is planning another $800 billion increase in their own defense spending capabilities, and that benefits companies like BAE Systems. So there are opportunities there, and you shouldn't necessarily just react to the headlines to reposition your portfolios. But to your point, it does remind investors of the importance of diversification, using allocation to help smooth out some of these bumps and help you meet your longer-term
You know,
goals.
if we were talking about 6 months ago, the one thing we would be talking about the most is AI.
Yes.
At this point, do you think that there has been way too much of a bid in these AI-focused companies, and are these trades bound to sputter further?
The way I look at it is the AI revolution has a long road ahead filled with many potholes, and there'll be many winners and perhaps even more losers. But if I look at all large cap technology companies, they're not pulling back right now. They're doubling down, committing tens, if not hundreds of billions of dollars into building out their AI infrastructure plans. So when I see the Mag 7 now trading at roughly 27 times current earnings, that's the lowest they've been since the end of 2022. That represents an attractive buying opportunity to me.
You know, it's interesting, but how much uncertainty is there, too? Because we were talking this morning about how the Commerce Secretary has now put that CHIPS Act money in limbo for a number of companies. Do you think that puts pause on the trade even further?
It certainly makes you think about it, right? Because the supply chain is interconnected within the overall AI ecosystem. We talk about NVIDIA, which is leading the whole AI revolution, and I would argue is the hub of the AI ecosystem. But they don't make their own chips. Taiwan Semiconductor is the largest dedicated chip foundry in the world with a 60% market share. Their biggest client is NVIDIA. But Taiwan Semiconductor doesn't do their own lithography. They use ASML. So you can see the interconnected value chain that exists within the overall AI ecosystem. So it does matter, and I do have to pay close attention to that. But AI isn't stopping. If anything, there's going to be more investment opportunities down the road, and large cap technology has the balance sheets and they have the wherewithal to stick to it, pivot, and adjust accordingly.
Kevin, great to have you this morning. That is Kevin Mann of Hennian and Walsh joining us here on set in New York. Now, coming up, we've been talking about that CHIPS news. Commerce Secretary Howard Lutnick puts U.S. chip grants in limbo. We're going to give you details on that Bloomberg scoop next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the
the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's Jobs Day, and Bloomberg has the report under surveillance.
This is another read on the U.S. labor market.
Workers are staying longer than you expected. How did firms actually deal with that new data point?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
I do go back to what the lag time is between the soft data and the hard data. What's the lag data for the Doge effect?
That would speak to the anxiety of the labor market right now.
The March Jobs Report, Friday on Bloomberg.
This is the Bloomberg Brief, and I'm Sonali Basak in New York. Now to a Bloomberg scoop. Commerce Secretary Howard Lutnick may withhold grants promised in the CHIPS Act that would push companies to invest more in the United States. And, you know, the idea here is to bring a carrot here to go along with the stick. President Trump has indicated that he wants to scrap the act and use tariffs as an incentive for more U.S. investment. For more, let's get in Bloomberg's Michael Shepard in Washington. You know, this administration more and more looks like the stick approach might be the way to step forward, moving forward, at least on the onset. What would this do to have that type of pressure on companies in terms of withholding these funds that were promised?
Well, for the Trump administration, what they're hoping is that they're going to see more deals by using a stick like not only tariffs, but the threat of withholding some of this money to get semiconductor makers like TSMC, like Intel, like Global Foundries, like Samsung, to not only make good on previous commitments that they have made to put plants here in the U.S., but to add to them. They want them to double down. And we saw an example of that last month. We had Taiwan Semiconductor Manufacturing CEO C.C. Wei come to the White House and announce an additional $100 billion investment plan in the U.S. That's on top of a $65 billion commitment also. And look, Sonali, this was made at a time when we were thinking of tariffs as perhaps the only stick that the Trump administration would wield to encourage companies and encourage businesses to move and house more of their work here. But now we're seeing the CHIPS Act maybe being thrown into play, too. And remember that a lot of the money that was committed under the CHIPS Act that Joe Biden signed in 2022 hasn't actually been paid out. Companies have to meet benchmarks, and it'll take years for them to do so. So the government is actually sitting on a number of those checks, and it can use them, maybe in the Commerce Department's view, to get something out of it.
You know, Mike, at the end of the day, is it that surprising to see them take aim at the CHIPS Act, given the controversy around some of it in the first place?
No, it really isn't, and also simply because it is a legacy program that was signed into existence by Joe Biden, it automatically has a chip against it, so to speak, in the views of Trump and his advisors. They spent a lot of time talking about and deriding other Biden-era policies, and this is one in particular that Trump has targeted. He has seen it as something that is really unnecessary, and he would like lawmakers to repeal it. Now, the chances of that happening are very slim. Congress generally supported it on a bipartisan basis. They like the idea of these subsidies, especially because the money goes back to their states and districts. And yet there are areas where they may try to make some tweaks and adjustments, and that includes areas like the tax credits that are also baked into it. And those tax credits hold a lot of appeals for the company, too.
Mike, I want to point out another move this morning because it's been interesting to see where the current administration parts from the last one and where it actually has something in common. This morning, you had that news break the wire, of course, that executive order that Trump had signed to crack down on ticket scalping and fees that have been driving up the cost of attending live events for consumers. You know, the Biden administration had been looking at junk ticket fees as well. What does this move do to advance the pressure on live event companies?
Well, it's a great question, Chanel, because this is one of the few areas where we see the Biden administration and Trump administration actually have some common ground in the exercise of economic and consumer-oriented policy and enforcement. Trump signed this order flanked by none other than Kid Rock. He is one of the highest-profile entertainers to really be a full-on Trump supporter in an industry that generally has kind of turned a cold shoulder toward the president. But what Donald Trump wants the FTC and the Treasury Department to do is take a closer look at this market. One of the big complaints is that there are computer bots out there that are buying and rebuying and reselling tickets and driving up prices. And not only do consumers like you and I get the shaft, so to speak, we have to pay so much more to see entertainers, whether it be Kid Rock or James Taylor. The ticket prices are up across the board. But entertainers also say that they are not getting a cut of those proceeds. And instead, it is going to companies like Live Nation, which owns Ticketmaster, and SeatGeek and others that are now drawing scrutiny under this order.
Now, I want to go to the states as well before I let you go. We want the latest on the Wisconsin Supreme Court race, the House special elections in Florida. There's a lot to watch across the country this week.
Well, absolutely, and these will be referenda on how the country so far is viewing the Trump administration in its early days. And why is that? And in Florida, let's take a look there. This is an election to fill the seat that was held by Mike Waltz. Now, that could be viewed as maybe a safe Republican seat, and yet we're watching the Democrat actually wage a pretty tight race against the Republican contender there. And then turning to Wisconsin, this is over the Supreme Court in the state. Elon Musk, who was one of Trump's closest advisors, he was his biggest financial backer during the 2024 presidential election campaign, and he also helped support a number of congressional candidates. He has put a lot of effort and money and time into trying to make sure that there is a Republican victor at the end of the day in this Wisconsin Supreme Court race. And control of that, Elon Musk says, is essential to ensuring that the president's agenda and the conservative agenda take hold in this state, which is seen as a crucial swing state in presidential elections, but also it's one that, you know, they want to make sure that there is congressional representation that is majority Republican here in Washington from Wisconsin.
Certainly a lot to keep your head around when you think about all the moves in Washington on the state level. Bloomberg's Mike Shepard in Washington. We thank you for your time. And now we're going to bring you into another Bloomberg scoop because U.S. automakers are now making a last-ditch effort to sway the Trump administration on tariffs that are set to affect this week. Brendan Murray, who leads our global trade coverage, joins us now. You know, down to the finish line, ultimately. Of course, automakers are going to be heavily affected, and not just from the first set of tariffs, but of course, that talked about next set of tariffs that could also impact the parts. What can they do at this juncture, Brendan?
Well, what they can do is plead to the Trump administration that if they go ahead with what's proposed, it's going to lead to job losses, delayed investment, and weaker profit outlooks. So the auto companies we're reporting today are making that case to the administration. They're facing tariffs of 25% starting on Thursday on fully built cars from abroad and car parts in early May. So sort of a double whammy there. And on top of those tariffs, you'll have the reciprocal levies that the president is going to announce tomorrow on various trading partners from South Korea to Japan to the European Union. So the automakers are trying to make their case that they're the ones who are really going to take it on the chin, and it will be counterproductive for the administration to go through with these if what they want is a revival of the manufacturing base in the U.S.
You know, there is a level of of specificity to their demands or requests, rather, that are worth pointing out. They're looking for exemptions on low-value parts, electrical wiring, things that could be labor-intensive. Do you see the ability for some concessions?
Well, the administration has signaled so far that it's not open to any exclusions. During the president's first term, there was a massive program for exclusions that they think they've learned their lesson from. That if you provide all these loopholes, that you can't really accomplish what you want to accomplish. So we'll see how much of the case that the automakers are making that the administration takes on board. But as far as we can tell right now, those tariffs go ahead Thursday, and again, the car parts kick in on May 3rd.
Brendan, we thank you so much for all of your time this morning. That is Bloomberg's Brendan Murray. And there's another story, of course, we're tracking as well, a multi-billion-dollar one, SoftBank's AI push. The company is seeking a record loan of as much as $16.5 billion to fund AI investments in the United States. For more, we're going to bring in Bloomberg's Tom McKenzie. And $16.5 billion, we've seen SoftBank go to the banks before for large loans. This would be a record. So how much inclination would there be to get this done, particularly given how risky the broader environment is right now?
Yeah, Shanani, to your point, look, it's an indicator that Masayoshi Son and SoftBank continue to go all in on their AI bets, despite some of the questions being raised by analysts around data center build-out by Microsoft, despite the questions being raised by the president of Alibaba, pointing potentially to a bubble when it comes to data centers. SoftBank, Masayoshi Son, still going full bore on their AI bet, raising $16.5 billion US. And as you say, look, he's pretty adept at raising debt to put towards his big bet, and this is another example of that. Part of the money, we understand, will be going towards that $500 billion Stargate effort that SoftBank is leading alongside Oracle, alongside OpenAI and MGX in the Middle East. Part, it seems, will be going towards their backing, their ramped-up backing of OpenAI, which has just announced it's raised that $40 billion US at a $300 billion valuation. So we'll see exactly where the chips lie. There is, of course, a question mark in terms of what this does to the credit profile. Some ratings agencies have come out and said this does look like it's going to deteriorate and weigh on the balance sheet of SoftBank, and you've had some credit rating downgrades on the back of that. The stock in the session over in Japan largely unmoved on the back of this, but that could be a longer-term contention if, of course, these bets don't turn around, or at least turn profitable in fairly short order for Masayoshi Son.
Now, do we know how he's going to look to obtain this loan? It looks like it's going to be a bridge loan with a 12-month tenure. Do we know why they're doing that, given that, to your point, they're looking at a credit outlook on the decline?
Yeah, so it's got that 12-month outlook, which is why I referenced, needing to see these returns they can't be pushing out and building out a view that they're going to be getting returns in 5-10 years time if they got a 12-month tenure on this debt. Look, they have assets, right? SoftBank, they have the assets in Japan in terms of the telecoms business. They have, of course, their stake in Arm Holdings, headquartered in Cambridge, UK, of course, with the listing in the US. And then, of course, they have this stake now in OpenAI. So the assets are there for SoftBank that they can leverage to raise this kind of capital. It's not clear exactly why they've gone for a 12-month tenure and not pushed for a longer term. You can assume that it's down to the credit, or at least the details of the deal that they're getting from their creditors. But again, just a reminder that for some of these big players, they have not yet been constrained by some of the concerns in the market about the return on investment around AI, about return on investment around the infrastructure spend and the data center build out.
Right. Interesting that, of course, it is indeed a bridge loan, not a margin loan against those assets. Of course, asset prices these days pretty volatile. Bloomberg Daily Europe anchor Tom McKenzie, we thank you so much for your time this morning. Now, coming up, we're going to get you set up for your trading day. Of course, a lot to look for ahead of Liberation Day. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is the Bloomberg Brief, and I'm Sonali Basak in New York. We're going to give you a look at what's ahead today. Richmond Fed President Tom Barkin speaking at 9 a.m. Eastern Time. And U.S. auto sales numbers begin to drop at 9 a.m. And we're going to have U.S. PMI and JOLTS job openings at 10 a.m. Bringing you some movers under the surface as well. Pre-market in the United States, Live Nation falling after President Trump signed an executive order aimed at cracking down on ticket scalping and fees that drive up the cost of attending live events. We're also taking a look at Johnson & Johnson, also down after a federal judge rejected the firm's attempts to use bankruptcy to end cancer claims. And Newsmax is extending double-digit gains after its blockbuster debut on Monday. Looking at some macro movers as well, I wanted to take a look here at the bond market because it's interesting to see here that the U.S. two-year yield hanging firmly below 3.9%, but pretty much flat on the morning. You are seeing that bigger bid into the longer end of the curve. The 10-year yield dropping down to 4.18, down another 2 basis points after a 4 basis point move on Monday. The 30-year yield also catching a move of almost 3 basis points lower. Now that's it for the Bloomberg Brief this morning. Bloomberg surveillance is up ahead, counting you down to those tariffs. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of which you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
If we break down this week and universal tariffs are the reason, we could see something even lower than 5,500 in the short term.
There probably is still, to some degree, a level of a correction coming. There may very well be more to come.
The market's trying to find a bottom. Things will recover.
Markets are down. It's not just a rotation underneath the surface.
I've sensed this bearish sentiment on the rise, especially in the last few weeks.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday saying hello Q2, good riddance Q1. Closing out the first quarter with the biggest quarterly loss in more than 2 years. Downgrades to growth outlooks piling up on Wall Street. And a long list of price target cuts gets even longer. Policy volatility, sinking sentiment, and deep-seek surprises helping to upend the U.S. tech trade. Meanwhile, ambitious spending plans in Europe sucking capital into the continent and sending stocks there absolutely flying. Now, as the second quarter commences, one risk dominates. All corners of the global economy will need to confront so-called Liberation Day, a major tariff push just 1 day away.
Tomorrow, will we get clarity? Will we get details? Will we have a sense of what the tariff bazooka actually will be? It's telling that, as you just said, John, across the board, the downgrades are already happening before we even get the announcement, because the lack of certainty is likely to persist, and it's likely, as Mike Wilson said, to be the jumping off point for negotiation more than actually some sort of definitive prescription on tariffs.
And I think the Treasury Secretary last night actually opened the door to those negotiations. He said everyone, after this Rose Garden event on Liberation Day tomorrow at 3 p.m., everyone will have the opportunity to lower their tariffs, lower non-tariff barriers, stop FX manipulation, stop labor subsidies, providing cheap loans, and make the global trading system fair for American workers again. It starts as this is the start of a negotiation, not the end.
At the moment, everyone's lowering their forecast. Equity downgrades from HSBC, from Citi, price target cuts from RBC, from Barclays, from Goldman twice. Yardeni goes again. Ed Yardeni joins us later on this morning. New price target on the S&P 6K. Lisa, here's the quote. The expected fallout from Trump 2.0's reign of tariffs undercuts our former bullishness.
And they talk about the roaring 20s and how that scenario looks less likely, and the idea of some sort of stagflationary recession looks more likely. He said a happy outcome would be that the U.S. would negotiate tariff reductions, but that won't happen if the U.S. slaps a 20% tariff on imports all across the board. This is the key question for tomorrow. How big does President Trump go, and how much does that take off the table the potential for negotiating and putting this genie back at the bottom?
And how quickly can this story shift? Treasury Secretary Scott Bessent with these comments in the last 24 hours. No tax on tips, no tax on Social Security, no tax on overtime, and we're going to make purchasing an American car tax deductible once again.
So he was asked, of course, about the extension of TCJA, and he said, we are going to make those tax cuts, that is current policy, permanent. And then he said, we're going to layer in some of these other proposals we've heard from the president, not just on the campaign trail, but new ones we've heard out of the Oval Office. The issue is, I think it's base case that we get an extension of TCJA. It's those extra sweeteners. Can they really get through Congress?
manufacturers. And this is the issue right now with moving so quickly to try to restructure an entire economy that has been built up over decades, possibly in implementing the biggest tariff regime since the 1930s or the 1800s. It goes to this question of, are they moving quickly with a plan, or is this ad hoc the way a lot of people in markets are worried about?
We've got some data later this morning as well, 10 a.m. Eastern time. Look out for that. JOLTS, job openings, and later on this morning too, ISM manufacturing. From there, the data really starts to pick up. Equities on the S&P just about unchanged. Coming up this hour, Jonathan Stubbs of Berenberg following the worst quarter since 2022. Tobin Marcus of Wolf Research counting down to Liberation Day, and the former Fed Vice Chair Richard Clarida ahead of tariffs and payrolls. We begin this hour with stocks falling as traders await clarity on President Donald Trump's tariffs. Jonathan Stubbs of Berenberg looking at Europe's outperformance, writing Europe had its best dollar quarter versus US equities since 1985. Jonathan joins us now for more. Jonathan, welcome to the program, sir. Any reason for that performance, that outperformance, to continue?
Yeah, very good question. I mean, it's happened. It's in the history books now. Best quarter for Europe against the US in dollar terms for 40 years. Part of this clearly is a risk premium trade. We read about this back in October in a sort of path to upside notes, citing sort of Ukraine dynamics, German dynamics, and sort of Draghi progress as the key sort of impetus for this. What happens next? We have to obviously ask that, and it's harder now to make the same case that we were making back in October in terms of the quantum of upside for Europe. For that to happen, we need the show me phase to come. The show me is earnings growth coming through. We haven't seen much change to growth forecasts for the next 12 months. The US comes into play as well. The US, I would argue, is a broken trade at this point. Happy to go into more details why, but it's harder to make the same case for Europe going forward. That doesn't mean that Europe hasn't got reasonable upside going forward. It's just harder to make the same case that we were making back in October.
Let's talk about that broken trade. Nvidia, Google losing a fifth of market cap in a year so far. Tesla losing a third. The price is reset lower, Jonathan. Is it cheap enough for you?
So, trades can last for a short period of time, a long period of time. The American exceptionalism has been for 15 years of US equity dominance, US equity market outperformance. We've shown that a lot of that has been down to exceptional sort of US total policy impulse. If you measure the change in central bank balance sheet, the change in US government debt over that 15-year period is $30 trillion. That also matches the change in US equity market cap. So there's a very close link between how US policymakers have behaved over 15 years in the US equity market. What we're seeing now, we're seeing a price break in the trade, number one, and then number two, everything behind the US, which is what the Trump administration is doing, the rewiring of America, the remapping of the world, sets the scene for a different sort of set of fundamentals to take US equities forward. That's why it's a broken trade. Doesn't mean that US shares can't make further ground from these levels as we go through the next 12 months, but we're not in the same environment that we've been in for the last 15 years. That's a key point for global investors.
Jonathan, a lot of people have been redefining what it means to have American exceptionalism as fiscal stimulus, and simply it's been riding this wave of fiscal stimulus that the United States has been engaging in, and now that that's retrenching, exceptionalism is no longer on the table. Is it that simple?
Yes and no. I mean, the U.S. government debt has gone from sub $10 trillion pre-financial crisis to $36 trillion today, and there are forecasts 10 years out, official forecasts for that to go to sort of mid-50s. The Government Accountability Office in the U.S. has got a debt to GDP 2053 target above 200%, and says that America's on an unsustainable path, and I'd agree with that. But what's happening is that it's dragging everyone else into the same game. So everything that's happened in Europe over the last couple of months is centered on Germany. Is Germany now also playing that game of sort of global fiscal activism or competition? China's been playing it for a long time, supporting its development, especially in sort of industrial complexes like autos, etc. And so what we have now is we have part of this Brave New World theme that we've been writing about for 3 years now. Fiscal activism is at the center of that. Now Europe's playing the same game. The end result is higher for longer in terms of inflation and rates, and a completely different landscape for investors to engage with in terms of regional leadership and also leadership within equity markets in different regions.
So it goes back to what John just asked, which is how long can this continue, especially if you don't have the backing of, say, the ECB? And this came from Bloomberg yesterday, where ECB officials are questioning how much they can cut further because of exactly what you're talking about, this fiscal impulse. Does that curtail this ability of risk assets in Europe to lead and lead to everyone just kind of not benefiting from the American exceptionalism story?
Yeah, I mean, so the European equity trade so far has been risk premium. It's been a re-rating, hasn't been sort of growth. So Europe's now trading after the rally at sort of 14 times on a sort of forward PE. That's a long run average. So from here, to get further re-rating benefits, we need sort of liquidity to come to the region. That's starting to happen, but it's very modest. Otherwise, we need an earnings growth story. And the changes to our economist forecasts, post of German debt brakes sort of being relaxed across the whole European region amount to about 0.1, maybe 0.2% of GDP growth from 26 onwards. So it's a small growth delta in the grand scheme of things. So yes, it's helpful. Yes, it's different. But to sort of say this is a new era of European dominance is probably going too far. So I can make the case for 10% returns over the next 12 months without stretching growth assumptions, without stretching multiples. But to get into sort of 20, 30% and beyond, we have to see much more change in Europe. We have to see much more change on regulation, i.e. sort of more relaxed regulation. We have to see lower energy prices. Politicians can do it. This is the point. They can get there if they want to. Whether they want to is a different matter.
Hey, John, I'm just going to jump in. Sit tight. It's a fluid situation, of course. We'll get an announcement from the president tomorrow. But this news just dropped in from the Washington Post, and I'll share it with you. We should stress, and I've said that repeatedly, the situation is fluid, but this is their lead story at the moment. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports into the United States, according to 3 people familiar with the matter. This coming from the Washington Post just moments ago. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports into the United States.
So obviously that'll be definitely going to the dirty 15 that the Treasury Secretary has spoken about, especially the likes of Europe. We have to remember they're not just using tariffs, they're also talking about non-tariff barriers that they want to make up for. Interesting also, this story continues to say the team is also exploring using those trillions of dollars from raising the walls and the tariff barrier into the United States for a tax dividend or refund. So finding money elsewhere to then cut taxes or give money back to the American people.
Jonathan, this could change, of course. It might not be approved by the president. We'll see. But this is the reporting coming from the Washington Post just moments ago. I'll repeat it again. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States. Jonathan, if that goes through, if you hear those words from the president tomorrow in the Rose Garden, how would this market react?
This is Brave New World. This is fiscal activism. This is the era of big government. So the wires and price action is being dominated by geopolitical events. That is our framework strategically. This is also uncertainty into markets. Markets don't like uncertainty, so that makes it difficult to make some near-term progress. But ultimately, investors have got to get their heads around what this Brave New World is, what it means, and why. For example, the best sort of performing assets year to date are European banks, gold, and Hang Seng. That's a very different world to the world that we've been living in for the last 10 to 15 years. It's all about the structure of the framework. That's what we've been writing about for 3 years. So all these events are events within that framework. Fiscal activism, big government leading to inflationary pressures, higher for longer. This is not a US-led, growth-led world anymore in terms of equity markets.
Ursula von der Leyen has said, if necessary, we have a strong plan to retaliate and we will use it. Is that where you still want to hang out then in European banks?
Well, this is the world has gone from an era of 30, 40 years of globalization dominating to deglobalization and fragmentation. So every region is having to sort of drive their growth or protect their growth more themselves, and that is a function of everything that we're seeing. Arguably, Trump is driving sort of American policy and also European policy right now. I would say, and the Europeans are in many respects reacting rationally. I also note that von der Leyen was sort of quoting IMF data earlier today and talking about the internal tariffs in Europe, which are up to 100% on sort of services. So Europe's got a lot of heavy lifting to do domestically to be more competitive.